Negative because you could see potentially Chinese cars, EVs coming in here. The Chinese are going to build here anyway, so maybe this is a moot point, but nevertheless it'd be interesting to see how that sector responds to the story. But I think the technology story around the debate could be quite interesting as well. So
it is.
Names like ASML in focus this week.
Especially because that's just kind of held in between the sanctions story. We have to see how tough they go. It feels like Biden wants to be tough on China, Trump wants to be tough on China. What does that show up in the markets? Let's look at it right now. When you look at the market open, it looks like the FTSE 100 starting off on the back foot here, a little bit down, seeing a little bit of red. AstraZeneca, Shell, these are your biggest index weights right from the get-go.
So oil's been softening up. So we've seen this big rise in oil recently. That's beginning to roll over just a little bit, despite the fact we have really strong aviation demand, and actually the driving story out of the States is interesting. Yeah. But does that higher oil price that we've seen recently show up in the PCE data Friday? I think will be interesting. You're right. AstraZeneca, BP, Shell, all a little softer this morning. Anheuser-Busch seems to be gaining. Siemens up. Some of the banks are also bouncing back. ASML on the front foot as well. Interesting to see Nvidia selling off Friday as well. Is there a read across into the technology sector here in Europe too? At the moment, the bulk of sectors are in negative territory. Banks are rising, so that's certainly one area that we are seeing some gains. But there you go, the auto sector, the biggest lead gaining sector story this morning here in Europe. It is up by 0.5%. Craig Trudell will be joining us very shortly to talk about that tariff story.
Yeah, it's a really important one. And I should mention, this is one we haven't really talked about as well. UBS is one of your biggest upside contributors as well. From an index perspective, on Friday, it looks like FINMA had talked a little bit about how much they're going to be regulating UBS and post-Credit Suisse, of course, but in terms of those capital buffers, this is an ongoing story as well in terms of how the EU, and specifically how the left in France actually approaches some of these banks as well, do start to increase those capital buffers in Europe, specifically when Jamie Dimon has been really pushing back against that story over in the States as Europe has some catching up to do. That's something that the market has to pay attention to when it comes to the bank sector.
I want to go to a story that's just come onto my screen, and that is this polar polls that I thought it would be coming about half an hour ago. You've got to sort of do all the maths on this and figure out exactly kind of where we are. But this is the polar polls that Bloomberg pulls together. Marine Le Pen's far-right National Party, further gains in the first round. The first round, big critical, obviously, in that election that we've got coming up Sunday. So it looks like Macron increasingly looks like he is going to have to share power. It does look as if the right and the left are likely to be in that second round rather than Macron's party. So it's going to be, again, French politics front and center, but this does seem to confirm that Le Pen is making further gains.
Yeah, Allianz doing a great analysis over the weekend. I read in The Economist, I believe, that basically, if there isn't some sort of Macron leadership, either way, you're going into some really scary deficit territory from France. Does that then invite, perhaps, yet another sovereign downgrade down the road?
Maybe for others, yeah, potentially.
Yeah.
I think that definitely is the risk this morning. French bonds, though, are a little bid this morning. Yields are just coming a little bit lower. Where does that mean we are in terms of the spread over Germany? We're trading at 78 bips over Germany this morning. Let's pick up. It's the perfect point to pick up with our next guest. David Zahn joins us now. He is the head of European fixed income at Franklin Templeton. Good morning.
Good morning.
France is trading 80 over Germany. How high could that number go?
Well, we're short France at the moment versus Germany, so we think it could easily go to 100 over.
Easily 100.
Yeah, and I think that's where we'd start looking to cover our short position. If we got wider than that, then I think that's when we start thinking about
What would get
buying.
us wider than that?
Well, I think that we have the left and the right both doing really well in the polls, as you pointed out.
Yep.
Left is has huge spending plans. The right has big spending plans, and we also have a deficit reduction plan from the EU saying, France, you need to get your budget deficit down, which has been a problem for a while. So I think all of this just means that French bonds should be trading wider. They should probably be trading more flat to Spain, and they're really looking at how they trade versus Germany.
Go ahead.
Okay.
That's the ball.
Sorry, I usually ask two and then you ask one.
No, go for it.
Let's talk therefore about what the wider implications are. You talk about the relationship with Bonos. You talk about the relationship with Germany. Let's bring in BTPs to the conversation as well. What's the ripple effect off the OAT market into the rest of the continent?
Well, we have to remember the OAT market is one of the biggest markets in Europe, and so it is very liquid. So as it pushes wider, it will impact other peripheral markets. We also have Italy is going to go into a deficit reduction plan, and you're going to have this discussion with the EU over the next 3 to 6 months of how they're going to do that. So I think Italian bonds, we're underweight Italian bonds as well because we think there will be under pressure as we have this disagreement or exchange with the EU as they determine how to reduce that deficit.
Can I ask you a market plumbing question here? Especially when we're talking about the risk of some of these increased capital buffers, this kind of holding on to some of the sovereign debt that, of course, is affecting the French banks. How does that show up in terms of the turmoil? Is there any sort of risk of some sort of liquidity crunch as people navigate this?
I don't think not in French OATs. No, I don't think there's going to be a liquidity risk. I mean, they're very liquid. They move quite easily. But I do think people will start to question, you have this big liquidity buffer sitting in OATs. Is that the right one to have it in, or should it be in something else? I don't know. But I think in general, banks always hold their domestic debt, and that makes sense because that's what the regulator wants.
What about in relation to what's going on in the States? Of course, that debate coming in on Thursday. Is that a tradable event for you?
I think the debate will be interesting to see how they both perform, what topics come out, but I don't see that really affecting the bond markets directly.
But relative to Europe, for example, we talk a lot about the debate in the context of China and what that tariff story looks like. We still have steel tariffs on Europe. There's still, I say we as in we America, tariffs on Europe. There's still a question of what kind of the IRA looks like or potentially looks like in the next 12 months. Is any of that something you can price in?
Well, I think all of those are longer-term issues, but I don't think they'll affect what the price of the Treasury is today. I think it's really, we know that we're going to have either Biden or Trump is going to be the president, and we know how they'll both act because we've seen them both, take office before. So I think that you can start to price in once you have a clearer view of who's going to be in charge, but both will want to spend more money. And so it's not like the budget deficit in the U.S. coming down, which will keep yields, I think, under pressure.
Let's come back to Europe.
Yeah.
You get Meloni's in power. You get Le Pen assuming more power. Some sort of a joint approach maybe is taken. It's not there at the moment, but maybe it comes. Does that take further European integration in the bond market off the table? Does it take joint spending off the table? Does it make harder for Europe to fund at a supranational level? Kind of what are the implications for the EU of some of these elections?
Well, I think overall in Europe, we've seen the right doing much better, and we saw that in European polls, but also in individual countries. And I think if you have 2 of the 3 largest countries are both in a far-right government, I do think it will impact how the EU behaves and how it moves forward, and it probably doesn't mean as much integration in the short term. I mean, obviously these things can go back and forth over the next 5 to 10 years, but I do think that Meloni is very strong, given how well she did in the polls during the European election. And she will use that power to actually try to push things around. And if you have Le Pen also coming in, I think you have 2 very strong leaders who will try to navigate the EU situation and probably make it different to what it is now.
Is the gilt market a safe haven right now?
Yeah.
Can't believe those words just came out of my mouth.
From EM risk.
Well, actually, it's really interesting you say that because we actually are overweight gilts versus Europe because we believe that actually gilts are a safer place to be than in Europe at the moment.
Relatively or just in general?
In general. We think that actually the Bank of England should be cutting rates. I'm not sure why they didn't, if it was elections coming up that they decided not to. But we think that the economy here is weaker and therefore we should have rate cuts coming through and gilts should perform.
Walk us through the logic of that. When the narrative seems to be in France, in the UK, arguably in the States as well, that if deficits are the concern and there's no real room to spend anywhere, what do you do? How do you price that?
Well, I think you have to look at which leaders are actually trying to contain spending. And I think in the UK, they've done an okay job of trying to rein in spending. And I think that's one of the things I'm not as concerned with Labour getting in is there isn't any money to spend. They don't have a lot of flexibility. So probably have to, and given what happened in previous administrations, they're probably going to have to keep it quite tight to make sure that we don't create any volatility in the gilt market. I think France, they may be a little bit more loose with the spending, depending on who gets into power. But I do think that a lot of people look to see what Meloni has done in Italy. And she's done an excellent job of, this is what her policies were when she was on the campaign trail. And then she really got it much more normalized for when she got into power to actually help the Italian government deal with the bond market.
I'm going to steal Guy's question really fast. Is that a function of fiscal spend, though, for Meloni?
It's a function of fiscal spend, yeah.
And can that be replicated elsewhere?
I think it can, but remember, Italy's been spending lots of money. So it's just, I think, more how they've been communicating with the bond market. Their deficit is will be above 5% this year, and they will be in this deficit reduction plan. So I do think it's more how the communication has happened.
We're starting to see credit going a little wider. What are the implications for the govies of that? Like, what is it? If this carries on, a couple of deals pulled last week. If that carries on and we start seeing credit going wider and wider, even at the IG sort of level, what does that mean for is there more space on the govie side?
Well, I would probably flip that question around and say that actually by govies going wider, it actually pushes credit wider, because all of a sudden you can move into governments that have spread over Germany and pick up yield versus what you'd have in credit.
So it didn't start. You don't think that move started in credit?
No, I think it started in the govies, and then it will flow through into credit, which is one of the reasons we've been reducing credit quite a bit over the last year.
When you're reducing credit, though, how much of that is simply a function of people kind of sitting on the short end of the curve? When does that dynamic go away?
I think the short end will go away once the ECB continues their rate cuts, which we anticipate they'll cut once a quarter for the next 18 months. So we're headed to 2% in Europe. And if that happens, then I think short credit isn't nearly as attractive. Right now, you can get between 3.5% and 4%. So why not just buy short credit, 18-month paper, and sit on it for the next 12 to 18 months? That actually seems quite reasonable. But once those yields come down, then I think people will start to push out the curve and look to see where are other opportunities.
Did the steepness finally happen?
Yes, the short end will outperform.
Yeah, they finally take off at that point.
Yeah, because the long end will be more anchored by what's going on in the U.S., whereas the short end will be more anchored by what's going on in the ECB.
Is 5% on the 2-year enough? Is that enough yield in the dynamic where you're seeing the stock market and EM currencies and everywhere yield double digits, private capital yielding double digits? Is 5% in the Treasury market enough?
I think it's enough for where we are now. I mean, we expect the Fed to still be looking at cutting next year or end of this year. And so I think in that environment, short rates at 5 seems quite reasonable. Now, longer term, if we go more medium term, like 5 to 10 years out, if we keep spending with 7-8% budget deficits, then you can probably start to question whether 5 is enough. But at the current juncture over the next couple of years, yes, it definitely is.
For now. We'll take it for now.
For now, absolutely.
David, nice to see you. Thanks for talking about us. David Zahn, Head of European Fixed Income, joining us from Franklin Templeton. Quick look at some of the big moves around Europe to see what they're doing. This is what the Core 6 looks like first thing this Monday morning. A reasonable amount of green on the screen, but as you can see, it's not a great deal. It's interesting to see Nestle maybe rising a little bit more than most, but it's Ferrari that is up and doing very nicely. The car sector front and center this morning as we see the possibility of tariff talks between China and the European Union on those car tariffs. We'll come back to that story in just a moment. Let's turn our attention, before we do that, to the other individual stocks we need to be watching. Joe Easton, back to you.
So we're starting with Prudential, Guy, and we are seeing a bit of a boost following that $2 billion share buyback that the company announced overnight. That was earlier than expected by analysts, and we're seeing an almost 5% gain in that company there. It was only expected to be around $1 billion, so that is much better than expected. We're also looking at the drink space, a couple of things going on that we mentioned in stocks to watch. Firstly, that activist stake in C&C Group, seeing a 1.4% gain on that one at the moment. But the big one is Britvic, that breaking news that PepsiCo potentially giving its approval on the bid that came in from Carlsberg. Now, Britvic actually has an agreement to bottle and sell a lot of PepsiCo products in the UK, like 7up, for example. So PepsiCo is kind of the kingmaker in this deal. They need to sign off from it, and they have said in a statement that if the deal goes through, they will be willing to back away from that and allow Carlsberg and Britvic to do their own thing. So as we can see on the screen there, an 8.5% gain for that stock, a really big move. And Carlsberg coming down, that stock was absolutely slammed on Friday following that deal news. Then we've got Argenx. We'll take a look following that drug approval in the US. It's a rare nerve disorder treatment, and it has got the US FDA backing. And there we go, a 7% gain for that stock today. Potentially a $3 billion market that's addressable for that company with around 36,000 patients. So it is a big drug, and that one is gaining over in Belgium today. We'll look at some earnings stocks as well. There's a few to bring up. There's Prosus, actually reporting its first ever e-commerce profit. Now, this is the company that's listed in Amsterdam and also has the relationship with Naspers. They own a stake in Delivery Hero, a bunch of other websites, but potentially the valuation looking a bit heavy on that one, and actually it's coming down very slightly there. A big dropper on the screen we've got, I'm seeing that one, SIG, down 15%, almost 14.6%. This is a UK construction supplier. They make insulation and stuff that goes into ceilings and roofs, that kind of thing. Getting absolutely slammed on a profit warning today, down almost 17% now, the worst performer in London. And you got THG down the bottom there. They've announced a pact with Frasers Group, a company that is, of course, owned by Mike Ashley and controls Sports Direct. This is around selling their luxury products via THG's platform Ingenuity, and that is seen as a positive, up 5% following THG's partnership with the retailer Frasers today. We'll look at the auto stocks because there are talks going on between the EU and China around tariffs. The EU and China potentially trying to see if there's any leeway on whether they can remove or at least not impose as strict tariffs as hoped on the car makers. We've seen some gains there, Volkswagen, Mercedes, BMW in Germany, all gaining, not so much movement in Renault, but the German car makers definitely getting a boost ahead of those talks today. Speaking of German companies, one stock absolutely slammed today on a ratings downgrade is Zalando. Now, this is the online clothing retailer and also sells other goods as well. And Morgan Stanley, a long-term buyer of that stock, downgrades it today. The stock was down as much as 10% at the open in Frankfurt. They no longer recommend you buy that stock. It's coming down to equal weight from overweight. And then my final morning call is Hochtief. This is in construction. Jefferies likes this one, upgrading it to buy. They say that the company is feeding into building data centers. So it's an AI play, a construction company that's potentially exposed to AI through the building of data centers. So Hochtief upgraded at Jefferies, and that one, big earnings upside and big price target upside, 124. I've just seen that, so potentially another 25% upside. That one's up 7% as Jefferies upgrades Hochtief.
All right, there, Joe Easton from our equities team. We thank you so much for walking us through some of the stocks that are moving in the early session. Coming up on the program, China and the EU agree to hold talks on the bloc's plan to impose hefty tariffs on EV imports. We're going to dive into the details next. Stick with us. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Our duty is to be able to provide our client the motorization they want. If they want ICE, if they want hybrid, if they want electric, we have to be ready for that. So for us, for me, I think it's fair to tell you which is the split of the model we will offer to our client. For forecasting what is the sales is difficult. If you want my point of view, it's clear that the three kind of colors, the three kind of car will stay together for a while.
Benedetto Vigna, the CEO of Ferrari, speaking to Bloomberg Friday as the company comes up with its details of what the new EV, the Ferrari EV, is going to look like and sound like and go like quite fast, I think is the answer to the latter question. That's where the magic all happens in that factory. Cars definitely front and center in terms of the European markets this morning. China and the European Union, they've agreed to discuss the bloc's plans, the European Union's plans to impose additional tariffs on EV imports, which could take levies to a level as high as 48%. That was agreed by Valdis Dombrovskis Friday. That was when that call happened. That's what that came out of. This at the same time as we see Germany's Vice-Chancellor Robert Habeck wrapping up his trip to Beijing. Let's pull this all together and try and get an angle on what is going on here. Bloomberg's global automotive editor Craig Trudell joins us from Oslo. Bloomberg's executive editor for China, John Liu, joins us out of Beijing. Craig, let me start with you. Why is the EU suddenly deciding that it probably needs to talk to China about this rather than simply imposing these tariffs?
I think there's a real concern here about blowback, and there was this was a deliberate process, and from the perspective of Brussels and the German Vice Chancellor, Germany in general, they viewed this as different and distinctive from what say the U.S. has done, which was kind of in short order put in place tariffs. The EU went through this 9-month-long process of investigating the extent of subsidization and sort of came up with subsidies and duty levels that it felt were sort of commensurate with the amount of support. There isn't necessarily a willingness, at least communicated thus far on the part of Beijing, to see that as different. There was really a sort of lashing out and highly negative response to this. There's already been talks of putting tariffs on big engine cars that would hit German manufacturers. We mentioned Ferrari off the top. So there's real potential here for blowback, and the EU would like to avoid that and sort of parse the differences between what they're doing and what, say, the U.S. is doing.
John, weigh in here from the perspective out of China, specifically when we're talking about these talks actually becoming underway. What concessions might be on the table from Beijing's end?
Concessions, I think it's hard to say right now. I think right now Beijing is out with the stick. I think whatever the carrot might be, we'll find out later. Beijing's learned from a trade war. We had the trade war with the Trump administration a few years back. And I think the lesson Beijing has taken from that experience is you got to talk tough. You got to be out in center with what you're going to do to retaliate if you want to end the day with a good negotiations.
Well, Craig, way back in on the negotiation that John is just talking about, because we know these negotiations are ongoing between, say, the likes of China and the States. How might Europe take a little bit of a different approach? And I'm going to put this in the context of some pretty harsh commentary coming from the likes of Mario Draghi, just one of many who are saying enough is enough.
Yeah, I think, one of the sort of things that's been, mentioned is maybe that the EU would like to have, localization of China's car makers, draw some investment and, have that, sort of support this idea of, building up of jobs and paying of jobs that at wages that companies in Europe are accustomed to having to pay. That's all well and good, but it sort of ignores the fact that, this is an industry that is so vast now in China where, manufacturers have so much overcapacity, both at the, end level of cars, but also, the batteries for electric vehicles is really important. That has driven down costs to such a dramatic degree that the rest of the world just, it's a real concern as to whether or not they're going to be able to compete. And so, until and unless that overcapacity is addressed, there's really a concern about the sort of long-term outlook for European manufacturers.
And John, let's come at that from the Chinese point of view. There is this desire by Europe to see manufacturing moving to Europe. And that is certainly something from a job point of view, you can understand why they would want to do that. How will the Chinese react to this? Are the Chinese authorities comfortable with the idea that we are going to see capacity moving out of China into Europe? We do, as Craig says, have huge amount of capacity in China currently. What do you think the authorities in Beijing, how do they want to see this story develop? Are they comfortable? Would they like to see Chinese automakers going global, or do they want to keep them at home?
So the fact that BYD is already committed to building quite a large facility in Hungary, the fact that we have battery maker CATL building a facility in Germany, I think it's inevitable that Chinese car makers are going to go abroad and build plants around the world, and that I think Beijing is okay with. I think the main concern at this point for Beijing is it cannot appear to a domestic audience to be allowing the Europeans to put in tariffs without doing something in response to show that it's standing up for Chinese interests. And so as long as that's in place, unless the Europeans, there's some negotiation about maybe taking those tariff levels down a bit, something that Beijing can walk away with and sell to a domestic audience as showing that it's done something to protect Chinese companies. Without that happening, I think Beijing's going to be under a lot of pressure to show it's tough.
John, is there another market, though, that Beijing could then target if you kind of see this worst-case scenario where you do see that trade limited to the U.S., limited to Europe, and in whatever method that looks? Where else are they targeting to make up the gap in terms of market share? Very quickly.
I mean, the biggest market right now is Southeast Asia. I think that's where you've seen a lot of expansion of Chinese marketing, sales, production. There are factories going up in Southeast Asia as well. So I think that's where China would look if Europe got cut off.
All right, Bloomberg Global Automotive Editor Craig Trudell in Oslo, and Bloomberg's Executive Editor in China, John Liu, joining us from Beijing. We thank you both so much for joining and bringing us that crucial context. We're going to be back with plenty of what the political turmoil looks like, how you price it in terms of the market. That conversation and more coming up next. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself. I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
There are some very good global players in Europe, strong secular growth players, and we would want to take advantage of that. Some of the corrections are overdone in our view.
It's a great day to invest in Europe.
When it comes to the government bond market, we have a preference for European government bonds and UK government bonds over US treasuries.
Positioning is very light. Nobody wants to be invested in Europe. Everybody's underweight Europe.
Can't help myself but be optimistic because against all that, you got a valuation 10 points below the S&P.
Sentiment is awful. Look at the elections, the growth prospect.
What I would look for actually is for the euro to stabilize first, and then maybe the equity market will follow.
When you look at projections for economic growth, the consensus is expecting Europe to rebound and start growing again in 2025, 2026, as opposed to what you're seeing in the US where we have a slowdown.
Some of the guests that we've had on our show in the last week really talking about the strength of the European stock market relative to the United States. We're talking about valuations, et cetera. Let's add one more voice to the chorus, or potentially one more voice to the chorus. Wolf von Rotberg, equity strategist at Swiss private bank J. Safra Saracen, joins us this morning. Wolf, we just heard from some guests talking about just how bullish they are on Europe, despite the backdrop that we're seeing of a lot of political volatility. Where do you stand on that? Are you bullish Europe?
No, not anymore. We've removed our European preference like around the beginning of June, more or less. We had moved Europe to, or the euro area in particular, to our most preferred market at the beginning of the year because we saw that the cycle is troughing, and obviously you would want to enter cyclical markets such as the euro area at a time when the cycle is just bottoming, and that's what we saw on the PMIs in particular. And if we look at the most recent data, I think we got a confirmation that we were right in terms of our positioning at the beginning of June. The PMI data, which we received last week out of the euro area, was quite soft. And I don't think that this had to do much with the French election or the European parliamentary election, rather than just being a function of, kind of the credit cycle rolling over once again and less, let's say, demand coming from outside Europe.
So what do you need to see to get more bullish here? How far do valuations have to drop for you to say that's a cheap buy?
It's not as much about valuations in our view. It's more about the cycle in general, as mentioned, which is rolling over. And then in particular on the rate side, I think, we've seen the banks performing quite well since the beginning of the year, which continue to be driven by by an expansion of their net interest income over the past, let's say, 16 to 18 months. And this seems to be rolling over as well. And we know the banks are a very important driver of the European performance. And we are just getting a bit more cautious on the banking sector in Europe. And again, regardless of what's happening in France and what's happening to bond spreads versus the Bund, it's more that the general interest yield, or the general yield backdrop is changing, saying the long end of the curve is coming off a little bit. And the short end of the curve, which matters for banks, which is basically deposit rates, which have been more or less nailed to the ground, are starting to rise. So banks are just seeing the peak of a very strong cycle they've gone through over the past 2 years, which just makes us more cautious here. So there's nothing right now which would let us become more optimistic from a like, let's say 6 to 12 month point of view on Europe.
Wolf, good morning, it's Guy. How do I hedge my NVIDIA concentration risk if I'm not buying Europe?
I would, for us, we are a bit more defensively positioned, saying, we've seen the very typical, kind of bond proxies, defensive sectors, healthcare, staples, utilities, or utilities maybe is a bit of a special one, but healthcare and staples underperform. We think that it has to do a lot with what's happened in the rate space, saying if yields come down, these guys should have some room to move higher. But we also like the utilities, and in utilities, obviously, we get a bit of a structural story here as well, with electricity consumption going up. More of a longer-term story has to do with AI to some extent, but I think it's still an interesting investor to be positioned in. In addition to that, and that's a bit of a trickier one, obviously, but I would still think that small caps have room to rise if we were to see the cycle, let's say not moving down sharply, but rates though coming off more aggressively. So rather stable cycle, rates coming off would be favorable for small caps, but in general, defensives.
Okay, let me ask the same question from a slightly different point of view. If I'm not putting money to work in Europe, if I'm not overweight Europe, what does that tell me about what I want to be doing in the United States? If I'm thinking about my portfolio, do I start with the States and then think about everything from there? Or do I if I'm a European investor, I start with Europe and think about whether or not I want to put money over on the other side of the Atlantic? The US market is outperforming. If I want to outperform as well, I have to be there. How do I square that circle with Europe involved? Or do I just not include Europe in that equation?
I think it makes a lot of sense to take exposure to the US. I think the US cycle has let's say a bit more breadth. It has a bit more life in it than the European cycle for the time being. I wouldn't go into the very concentrated AI space, just because I think let's say 6 to 12 month view, we may see a bit of a, let's say, normalization, at least, of the capex spending on AI, which, could basically hurt these valuations, which we are currently seeing. But in general, I think the cycle in the US could hold up a bit better, despite the high valuations, which we are seeing at the index level. But if we dig a bit deeper into the sector level, valuations don't seem to be as exaggerated as they are at the index level. So saying, we are neutral on the US market as well. We have a preference for the Swiss market in particular, which has to do with our defensive preference. But if I had to put it down, saying US or Europe right now, I think the US looks more attractive, again, on the back of a, let's say, somewhat stronger cycle. Not aggressively stronger, but somewhat stronger.
Wolf, does the currency picture factor into your thinking here? How are you viewing further weakness expected in the euro?
Yeah, I guess the euro will weaken somewhat on the back of what we're seeing in terms of political risks and in terms of the cycle. If the euro weakens in an environment in which the cycle is holding up for other reasons, then cyclical reasons, saying you have basically a sharper drop in inflation. Maybe the rest of the world is just doing somewhat better and is moving ahead. The euro is lagging. That's the best environment for European equities. But I think in the current environment, where the euro is more a function, let's say, of the European cycle itself, and of political risks potentially, I don't think it's as much of a support factor for European equities or for euro area equities in particular as it would be in an environment in which, you know, the rest of the world is just powering ahead in a more aggressive way. And here I'm talking in particular about Asia, where Europe, you know, tends to be a big derivative of in terms of the cycle, and we don't see the support coming from Asia.
Is the UK a safe haven right now?
In terms of the equity market, there may be a bit more stability. Obviously, it is more of a defensive market than the euro area is. But what I think where, you know, we should be a bit more cautious in the UK is in terms of the materials sector, the energy sector, where we are not as positive as we were just a couple of months ago. We also downgraded our UK overweight to a neutral in line with euro at the beginning of the month. Just because we thought, okay, look, we look at commodity prices, we look at copper prices, for example, we look at oil prices. There seems to be some weakness creeping in, again, a kind of derivative of the Asia manufacturing sector, to some extent of the US manufacturing sector, which has been weak on the ISM in the latest print. We get the next one on Monday. Let's see what it'll tell us. But definitely relative to the euro area, we would prefer the UK. That's for certain.
That's for certain. Wolf, great to catch up. Thank you very much indeed. Wolf von Rockberg, equity strategist at J. Safra Saracen, the Swiss private bank. Thank you very much indeed, sir. Okay, what else have we got coming out for you? We're going to focus on the UK. We've got an election next week. Let's not forget about that. We've got a business debate. It's happening live here at Bloomberg, 12:30 p.m. UK time. Anna is going to be moderating, Anna Edwards moderating with the Conservatives' Kimi Badenoch and Labour's Jonathan Reynolds. Very much looking forward to that. And we're going to talk about it next. This is Bloomberg.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Middle Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg.
This is Mark. Today we're about 43 minutes into the European trading day. Seeing some green on the screen, even though we started on a back foot here. Eurostoxx 50 higher by about 0.4%, so perhaps a little bit of optimism, but investors still very much on edge, especially in France, over the prospect of a change when it comes to the balance of power. There's a lot to digest when we're talking about the political turmoil. Sectors specifically having various reactions. Banks, highway operators, utilities, of course, at the forefront of a $240 billion sell-off on the Paris exchange. The far-right national rally continuing to hold a sizable lead in opinion polls, with President Emmanuel Macron's bloc trailing in third. I'm joined now from Paris by Julien Pontus, Bloomberg's French equity markets reporter, bringing us the latest on everything we need to know. Julius, let's start big picture. Walk us through the polls.
Well, in a nutshell, the far right is leading by 5 or 6 points to the left wing, and Macron's centrist party is way behind at 20%. So at the moment, there's no clear path to victory for Macron. It's we're just a week from the first round, and it seems like the far right will win this election, but will they have an absolute majority? Will they have a smaller majority than expected? It's anyone's guess. But one thing is for sure, Macron's party is not seen, winning this election.
Julien, that's the problem, though, isn't it? Because this is uncertainty. We just don't know. It's anybody's guess. This isn't a quantifiable risk that we're dealing with here at the moment. Investors have sold French banks, they've sold utilities. That feels like a logical reaction in so many ways. But how are they bigger picture? You talk to a lot of them, you talk to a lot of traders. How are they dealing with this uncertainty? And how long do they think this uncertainty will last?
For a lot of brokers, when you read their advice, they're basically telling you to stay away. If you're not in the French market, there's no positive scenario for you. There's no upside. If you need to be invested, say you're a French manager and you're selling, a fund that is exposed to France, then you need to cherry pick your way out of the safest, find the safest stocks possible. Basically, that's stocks that are, have 90–80% of their sales outside of France. They have no political risk. So you need to find, safe bets among, say, industrials or pharmaceuticals, or find ways out of the French political risk. But if you don't need to be invested in France, why would you?
Julien, can you walk us through kind of the sector-by-sector take on this? I mean, we paid a lot of attention to, of course, the banks naturally. It feels like they got the biggest hit. What are the other places we should be watching for in the market?
Media, for instance, the far right wants to say they were considering privatizing the French equivalent of the BBC. So that means a lot of more companies competing for a restrained pool of revenues. The far right has also said it was considering nationalizing motorways. So concessions operators are under pressure. Banks, obviously, you said there's big stress on the French national debt, the sovereign debt. So you probably want to be away from that. You want to be away from companies that have a lot of debt, because borrowing costs will likely increase. You want to stay away from utilities. You want to stay away from a lot of companies, basically.
So all of it, Julien?
That's a really long list, Julien.
There's a long list, and there's no... What strikes me the most is that across all the notes and the research and when you talk to traders or investors, there's not a lot of bargain hunting going on. It's more like damage control. How do I limit the damage? What is the safest bet? But no one is like betting on a rebound or like a great opportunity. It's really about, how do you minimize your risk?
And is that, once we get certainty, does that change? Is this about uncertainty, or is it just we now think that the rally's going to win?
It's going to get worse.
Okay, so that seems to be the tone, is it? That it gets worse, not better?
Well, there's no path for victory for the centrist party. So you're in the unknown. France has never been ruled by the far right unless, you go back to the Second World War. We absolutely don't know what's going to happen. Will there be a hung parliament, a technical parliament? Will the far have an absolute majority? Will it be like Meloni in Italy? Will it be like, a lot of fuss about nothing and things will remain more or less the same? It's really hard to tell. But there's no, hope of a big rebound come July 8th.
The only thing I hear is that we don't know who the next French finance minister could be. And if that French finance minister is perceived as having credibility, that may be something that the market can look to and see as a positive. Again, you talk to a lot of people. Are people talking about who that person could be? And could that be the person that maybe actually does provide some stability for the equity market?
Again, that would be like damage control if they could, pull out someone with a lot of credibility. Because when you talk to strategists, when they look at the French debt, they don't expect the spread with Germany to go back to where it was. It will be higher. There will be a higher discount on the French sovereign debt. So even if you find someone that has some credibility, it's about damage control. I don't see how in a month or so, their investors, foreign investors, Japanese investor will suddenly buy French debt.
Julian, it's going to be an interesting week. You guys are going to be busy. Damage control, that seems to be the tone that's come out of this conversation. Julian Pontus, Bloomberg's French equity market reporter, thank you very much indeed. Let's talk a little bit about what's happening here in the UK. It almost appears as if we're forgetting the fact that the UK is also likely to go to the polls. It is going to go to the polls. It is likely that we are going to get a Labour Party government. What does business want out of this? Well, we're going to try and find out today. Bloomberg is having a live televised debate. It's happening at 12:30 p.m. UK time. Anna is going to be moderating. Kimi Badenoch from the Conservative Party, the Labour Party's Jonathan Reynolds on the other side. You can watch it. We've got it live on Bloomberg TV. Globally, you can catch it, of course, on the terminal, the website, YouTube, etc., etc. Sam Munstead joins us now to kind of give us a little bit of a preview. What does British business want out of this election?
Stability. I think right now, because ultimately the picture for whoever comes in, and at the moment it looks very much like that's going to be a Labour government, it's not that good. The fiscal picture isn't that good. How much they can do, it's going to be mostly kind of tinkering around the edges, trying to improve where they can. But certainly for that first year in power, and we've got a nice story actually over the weekend on the terminal, you're going to be inheriting an economy that's not in particularly good shape. It's okay, but it's not in particularly good shape. And then you've got a picture beyond that unemployment is starting to tick up a little bit. You're going to have a lot of people in the country who are not enormously happy, and they're going to have to try to keep them all on board.
But Guy mentioned that it's largely expected that it's going to be a Labour victory. Of course, to be frank, anything can change, and until the very last minute, we know that in terms of elections. We're paying a lot of attention to the two largest parties. Let's talk a little bit about the Scottish National Party, the Lib Dems. To what extent does that affect policy?
So I think within this election cycle in particular, so Reform are obviously having an influence on the Conservative Party, right? However, at the moment, as you sort of just mentioned, Labour are way ahead in the polls. So from a business perspective and from a markets perspective as well, that's kind of all things that are bubbling in the background, right? At the moment, the main focus is on and now we're actually, earlier than you might anticipate, getting into the real details of what Labour's policy may be on business, on green energy, on, more broadly on the fiscal picture.
So we actually want some details.
Yes.
The Labour Party has said it doesn't want to raise taxes. What it wants to do is grow the perimeter of the economy, make the economy bigger. If it struggles to do that, how far are we from them talking about the Europe question? Because one of the easy ways you could argue to grow the economy would simply be to change the relationship with Europe, assuming that Europe would be willing to do that.
Yeah.
Let's assume as well that they want two terms. How far into Is there an expectation from business that this is going to be something that changes in a significant way?
I think there's an increasing expectation that it will become part of the conversation, maybe even within that first year. So as we've gone through the campaign, there's been lots of commentators around saying, why isn't it being talked about more? And the Liberal Democrats were the ones who really started to push it a little bit further, and now Labour have addressed the question a bit, but very carefully, as you might expect, because they're still within the campaign. I would think within the first year or so, that will start to be a question that's asked more and more, especially if, as you're kind of mentioning there, the economy continues to kind of bump along at quite a stagnant pace.
Can we talk about the market reaction here? I think you're the perfect person to do that with. How do you trade this? Is there positioning that's being built around this right now?
Yeah, I mean, actually, something that was interesting is that, so it was what you guys were just talking about, the French elections, and when that happened and we got this big sell-off, all of a sudden there were lots of strategists saying, oh, now the UK looks quite solid, right? Because it's kind of boring is beautiful.
Relative to France.
Yeah. But the flip side of boring is beautiful is that there aren't that many catalysts. So actually, the UK got a little bit of a boost, from people saying, OK, maybe we'll put our money there because things are looking a little bit less stable in France. But there aren't that many catalysts to push it on. So actually, in the intervening couple of weeks, everything's been quite staid. So the real catalyst remains, beyond the politics picture, the Bank of England and when rates are going to change. And that is going to remain far more important, I think, than policy, certainly in the near term.
How big an impact? How quickly do you think the Bank of England is going to have an impact? I guess is the other question. And again, this comes back to how quickly does the Labour Party start to feel the effects of a better economy? I guess is the question that I'm really asking. Policy is likely to still be restrictive.
Yeah.
It's just not going to be hitting the economy, therefore, as hard. So is there an expectation that the economy, once we see rate cuts coming through, will start to pick up materially? Because if it doesn't, again, Labour's got to answer that question about how do we get this thing going?
Yeah, I don't think there's any expectation that, as you say, they will pick up materially. So we just had the last meeting. We're going into that meeting thinking, in all honesty, it was going to be one of the dullest Bank of England meetings for some time. I would say it probably was still one for the Bank of England nerds out there, like us on Markets Today. But it sort of points very clearly to August, right? But as you mentioned, cutting from 5.25% to 5%, still very much in restricted territory. Maybe you get a little bit of a boost in the housing market, maybe, but it's not going to have a huge amount of impact, right? And everything at the moment is still kind of bumping along at quite a kind of slow pace.
We had a guest on today who, for the second time in the last couple of weeks, has said there may be a safe haven story in the pound. Would you agree with that? It wasn't too long ago. I'm old enough to remember that it wasn't too long ago where, don't look at me like that, that when it was being compared dramatically, obviously, to an emerging market currency.
Yeah.
And now it's a safe haven?
I'd say that's a push. Yeah. I think it looks safer than it used to, but that's partly because of the political story in Europe, political story in the US as you go through the rest of the year. I think calling it a full-on safe haven might be a little bit of a push just now. Yeah. But, you do have a policy picture politically, which is looking fairly flat. The Bank of England is likely to sort of cut rates, but not enormously over the course of the year. So it's fairly calm.
So a relative safe haven in a sea of worry.
An emerging safe haven.
An emerging safe haven. If you take anything away from our show, that's what you need to know. Sam Munstead from our Markets Today blog, we thank you so much for walking us through all things UK, from the politics to the market read-through. Of course, don't miss our interview with former UK Chancellor Philip Hammond. He will be joining the Pulse in just a few minutes. Guy, we're talking a lot about the election, the political turmoil as well. There's a couple of other things going on this week. Paris Fashion Week, which I'm sure you're very attuned to.
I am.
For me, it's the US debate. That's what I care about.
We're going to talk about French fashion tomorrow.
We will, I'm sure.
I'm going to make sure.
Okay. Guy's going to dress fashionably and talk fashionably tomorrow as well. We've got the debate, of course, on Thursday out of the States. We've got the data coming in on Friday. There's a lot to digest.
Riksbank as well on the agenda too. Can't ignore that. Lots of Fed speak, lots of ECB speak this week as well. So that may set the tone as well. As Cruddy says, it is the Pulse next. Tom will be guiding you through that. Philip Hammond will be joining him. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. Here's what's coming up on today's programme. Markets on edge as traders gear up for a week of political and inflation risk, with elections, a US presidential debate and the Fed's preferred price gauge all on the agenda. Bloomberg's poll of polls shows Marine Le Pen's far-right national rally making further gains over President Emmanuel Macron's party ahead of the first round of France's snap elections. Plus, UK Business Secretary Kemi Badenoch and Shadow Business Secretary Jonathan Reynolds go head-to-head in a live debate right here on Bloomberg, 10 days before Britons cast their ballots in the general election. We will discuss that and more with Philip Hammond, the former UK Chancellor of the Exchequer and Foreign Secretary, who joins us live here on set in a few moments' time. It is a big week, as well as the politics, for the economic data. We are getting data right now in terms of the IFO Business Confidence Index for Germany for the month of June, coming in below the estimates. 88.6 is the number. The estimates had been for 89.6. In terms of IFO expectations, that index coming in also below the estimates. It's a print of 89. The estimates had been for 90.7. The IFO current assessment index also a little softer, marginally softer, 88.3 versus the estimates of 88.5. But the redhead is focused on the business confidence part of this survey, coming in below the estimates, 88.6 versus the estimates of 89.6. Euro dollar at 107, checking in on the moves right now on a one-day basis in terms of the trade. 107, just a little bit higher, up 0.2% versus the US dollar. This is giving us a little bit more clarity, of course. We get inflation data out of Spain, Italy and France later this week, which will all feed in to the direction of travel for the ECB. Let's check in on the European European markets right now. A little bit of upside coming through after a week, in fact, where you ground higher for European stocks. US stocks ended Friday slightly lower, but in the session today, this Monday, modest gains coming through. In the basic resources space, a bit of a challenge there. There's slightly softer iron ore prices tied to fresh concerns about the real estate market of China and a build-up inventories in the world's second largest economy. The FTSE 100, though, managing to eke out gains so far in the session. We, of course, continue to monitor the risks, the political risks of France, with new polling data suggesting that Macron's party remains in third place. In terms of US futures, let's flip the board and have a look. Euro dollar, we've just marked that at 107. Also looking at the crypto space because Bitcoin remains under pressure. You can tie that arguably to what's happening in terms of expectations around interest rates out of the US. 62,000 on Bitcoin, the biggest, of course, cryptocurrency in market cap terms. S&P futures currently pointed to gains of 0.1%. Euro dollar up 0.2 at 107. Now, later today, UK Business Secretary Kemi Badenoch and Shadow Business Secretary Jonathan Reynolds will go head-to-head in a live televised debate moderated by Bloomberg's Anna Edwards here at our European headquarters. They're also going to face questions from Britain's leading business groups. Viewers in the UK can catch the business debate 12:30 p.m. UK time Monday on Bloomberg TV. For our international audience, it's also going to be on the terminal, the website, YouTube, and on Bloomberg Radio. So ahead of that debate, very pleased to say we are now joined by former UK Chancellor Philip Hammond. Also with me is Bloomberg's UK correspondent Lizzie Burden, of course, has her finger on the pulse firmly of all things UK politics and economics. Philip, thank you very much for joining us in the studio. And Lizzie's going to come to you with a couple of questions as well. I want to start with where we stand in terms of the electoral fight for this Conservative Party, and particularly the news out of the weekend that potentially 4 senior members of the Conservative Party have been allegedly linked to putting bets on the timing of the election. Is it fair to say that that is the nail in the coffin of any Conservative Party hopes of avoiding a landslide Labour victory on July the 4th?
Well, look, the polls are certainly pointing towards a significant Labour victory. I think that's the reality of where we are. My own view is that for many of the electorate, the die was cast back in 2021, 2022, the shenanigans in Downing Street during Boris Johnson's reign, the short-lived Liz Truss government. I think many people made a decision then that they wanted to change, and it's been Rishi Sunak and Jeremy Hunt's misfortune that despite having done a perfectly decent job in office, it hasn't shaken people from that view. So I think the issue now is about, if we do get, as the polls suggest, a Labour government, making sure that we've got a credible opposition to hold that government to account. Because I'm afraid I don't buy much of the stuff I'm hearing from the Labour frontbench team. I think their heart's in the right place, but I think they grossly underestimate the challenges they're going to face in addressing Britain's economic problems.
We'll certainly move on to that and get your views in more detail on that. But before we do, I just want to get one more question on this betting scandal, and whether I think for some it will point to symptomatic, arguably, some would argue, of the challenges, the corrosive nature, the rot at the centre of this Conservative Party. Would be the allegation from some that this is symptomatic of a fundamental issue eating away at the heart of this Conservative Party. Would people be wrong to come
well,
to
I think that's an overstatement of the problem. There is a problem, and I think the problem comes from leadership, and I think we've gone through a period when the top leadership of the party has not sent strong enough signals about the requirement to comply with basic codes of ethics. I mean, people in politics, people in public life have to know instinctively what is right and what is wrong. And knowing that you can't place a bet on an election, the date of which you're partly privy to setting, is sort of ABC 1, 2, 3. Everybody should know and understand that. But we've been through a period a couple of years ago when there was a very corrosive mood around ethics and rules in politics, and a sense that no rules applied. And I think that's deeply damaging, and the sooner we can sweep that ethic away and get people focused back on what I would call a traditional approach, a public service approach to holding public office, the better.
So would you draw the same parallel that Michael Gove has drawn between Partygate and, as it's now being known, Gamblegate?
Yes, I think that's right. I think that's when the rot set in.
And would you say that actually your party could do with a bit of time in opposition to regroup?
Well, look, In a democratic society, it's right that parties alternate. To be very honest with you, I don't think that's the debate we're having here right now. The debate we're having now, looking at the polls, is whether it's healthy for the country for the Tory party to be reduced to a rump. And it isn't. It isn't good for Keir Starmer and the Labour Party. It isn't good for the country. It's certainly not good for the Conservative Party and the future of our economy. We need, whoever's in government, we need strong, coherent opposition. And the attack from the right, fragmenting the Tory vote, tempting people away to vote for a man I can only describe as a snake oil salesman, offering solutions to Britain's complex problems that are apparently simple. That's the paradox of populism, offering these very simple, apparent solutions that will not deliver and that only may, in the end, make people more and more angry that their problems are not being addressed.
And to be clear, you're talking about Nigel Farage.
I am.
The head of the Reform Party, who is that threat on the right for this Conservative Party. One complex issue that this country and others face is what is happening on the ground in Ukraine. So we've drawn your experience as Defence Minister, and he's come out, Nigel Farage, with what many would say are pretty controversial comments about who was at fault in terms of Russia's invasion of Ukraine. I wonder if a significant gain for the Reform Party at this election would be a victory for Vladimir Putin.
There's no doubt at all that Nigel Farage is acting as an apologist for Vladimir Putin and his aggression in Ukraine. There's no question of who's at fault. One country has invaded another without provocation. The fault lies in Moscow. The fault lies with Vladimir Putin. That's the end of it. And to suggest otherwise is frankly just to give succor to Britain's adversaries.
So there's no culpability on the West's part for Russia's invasion of Ukraine. There was no sense that anything that the US or the EU did actively encouraged this to happen.
I don't think the West or the US did anything to encourage Russia to invade Ukraine. Absolutely not. But look, we've got to be clear about this. Independent sovereign nations have the right to engage with other nations, to contemplate joining international organizations, so long as they're for defensive purposes. That's absolutely inoffensive. And it's quite wrong and dangerous to suggest that, for example, Ukraine negotiating with the EU to join the EU could be regarded as a justification for a military invasion and the slaughter of hundreds of thousands of people. It's absurd, it's preposterous, it's grotesque, frankly.
And just to come back to the threat from Nigel Farage to the Conservative Party, do you see a world in which potentially he could take over a merged Conservatives and Reform new party post-election?
Well, I don't think so, because I agree it's a threat we need to consider. What Nigel Farage is doing is splitting the anti-Labour vote in a way that the only outcome from which would be, frankly, a less effective opposition to Labour. And as I said earlier on, while I'm prepared to concede that the Labour Party has said some things which are welcome, like it's said that it understands that economic growth is the only solution to Britain's problems, it also does not have a magic bullet or even a master plan for delivering that economic growth. And when it fails to deliver, my fear is that it will be dragged to the left by the forces within the Labour movement. And at that point, the quality of the opposition, the unity of the opposition is going to be crucial to avoid the country being pulled off course and negative messages being sent to entrepreneurs, investors through excessive taxation, excessive borrowing, excessive government interference, excessive regulation, all the things that we know the left tendency within the Labour Party, I'm not talking about the leadership, but the left tendency within the Labour Party would love to see.
Has this been a Conservative Party, the one that we're seeing right now, of high taxes? I mean, historically, we draw back to the Second World War in terms of where we are, in terms of the overall tax burden. Where would you like the tax cuts to land? And how much faith do you have in the Labour Party in terms of their commitments on tax?
Well, I'll be perfectly honest with you. I would like an honest debate about this with the public. There is right now no scope for tax cuts unless we are prepared to see significant reductions in public services going forward. Because of our demographic profile, with the population getting older, more people outside the workforce, fewer inside the workforce to support them. That's not a problem that's going to go away anytime soon. This is a structural challenge facing the country. If we can achieve very high levels of growth, very high levels of productivity growth, then there's a chance we can work our way through that. But there will be some difficult decisions to be made. And anyone who tells you that you can have tax cuts and improve public services is not being straight with you.
Okay, the complexities of how to fund the future government, whoever takes over. Philip Hammond, of course, former UK Chancellor and former Defence Secretary, of course, amongst another number of different portfolios across the UK government over his time in service, plus, of course, our UK correspondent, Lizzie Burden, with the questions there as we lead up to the vote here in the UK on July the 4th. Coming up, we're going to take a look at how markets are positioning going into the second half of 2024 amid that political risk, certainly out of France, and what data we are watching out for this week. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back. This is The Pulse. I'm Tom Mackenzie in London. Now, markets are at a critical juncture for positioning into the second half of 2024, with the outlook for central bank policy rates unclear, murky, amid heightened global political risk. We're also getting a lot of inflation data out later this week, including the PCE gauge out of the US. All of that, of course, building into these markets this Monday morning. I can now bring in Wei Li, BlackRock's Global Chief Investment Strategist and Managing Director, brilliantly positioned, of course, to talk us through what this market is facing. Wei, in terms of that uncertainty, the inflation risks, the central bank uncertainty, the inflation question, and then the political risks, how should markets, how should investors be thinking about the near-term challenges? Is there a case for standing and staying on the sidelines until we get more clarity?
Well, if we de-risk and stay on the sideline because of elevated uncertainty, we would have missed the incredible rally in the U.S. equity market so far this year. So the answer is not to stay on the sideline, but to deploy risk budget strategically and deliberately. So specifically to your point about all this uncertainty coming from inflation and also with the elections coming up, how do we think about it? Let's take them one by one. Inflation, we have PCE coming up this Friday, but CPI and PPI have been better behaving recently, so it is reasonable to expect PCE to continue this narrative of inflation slowly coming down, not in a straight line, but goods deflation still having room to take overall inflation lower, supporting the case for Fed starting to cut rates this year, which is why markets currently pricing close to 2 cuts.
Does that seem reasonable, 2 cuts at this point?
It is our expectation for this year, 2 cuts, and this stands in sharp contrast to what markets were pricing for at the beginning of the year, 6 cuts. So it has come a long way towards the high for longer narrative.
You and the team were never at 6 cuts at the beginning of this year.
We were talking about 2 cuts at the beginning of the year.
And they've come around to that view.
Yeah.
Longer term on the central banks and the neutral rate, because I know you have a view on this, R star and where we land. You do think the neutral rate is going to end up higher than maybe historically, at least recent history has had it?
Absolutely. So we think that neutral rate has risen to reflect the higher inflationary environment that we are in now because of the structural forces coming from aging population, coming from geopolitical fragmentation, and also coming from the low carbon transition. So in the context of the higher inflationary environment and also higher indebted levels, not just in the US, but across developed market economies, neutral rate has risen, but on top of that, central banks are likely going to have to even lean against that. So even stay tighter than what neutral rate would suggest because of the new structural environment that we're in right now, which is why we have
what then is the implication for how you position in the equity markets? Where are you finding positioning that is resilient to that higher neutral rate from the Fed?
Well, in equities, we like equities. We have been overweight equity for a while now, specifically preferring equities over bonds. So if you think about kind of the higher for longer rate environment that supports higher nominal earnings, which we have seen coming through supporting the momentum of equity so far this year, but higher for longer may not be as interesting for bonds if you're looking at bonds from a capital appreciation perspective. If you want to click coupons, certainly now you can collect higher coupons for a longer period of time, but we like equities better at this juncture because of the earnings momentum and also the fact that you can use specifically US equities to play the AI megaforce.
Yeah, and you've been very clear in terms of your preference, or at least how you favor the AI trade. You think that has a way to run. What would you say then to those cynics who would say this does have echoes of the dot-com bubble, particularly the likes of Cisco, and you're not going to talk individual names, but Cisco in 2000, a big play in terms of its hardware building out for the internet. Now you see chip makers as well within that space. How do you justify what we're seeing? How do you address the concerns that this is an overheated market and that at some point it's going to run out of steam?
Well, the difference between what we're seeing right now versus kind of the dot-com bubble is that earnings are coming through, and it's not just kind of earnings expectations are getting revised higher alongside equity price going higher, which is almost in lockstep, but also these companies are actually surprising to the upside versus the elevated earnings expectations. So, and pricing power of some of these chip makers is really unparalleled at this juncture. So we do think that there is more to go, but Magnificent 7 or Magnificent 6 or 5 is not necessarily the only way to play the AI theme. So if you think about the significant infrastructure build out that is needed to really provide kind of the ecosystem for the AI theme to be adopted on the overall economy-wide scale, infrastructure, industrial, material, energy consumption is almost still underappreciated. These are the sectors that we would like to kind of think about as AI theme broadens out, not just public market, private market as well, infrastructure in particular.
Okay, really interesting, the broadening out of that AI theme. Wei Li, thank you very much indeed. BlackRock's Global Chief Investment Strategist and Managing Director on the near-term and longer-term risks and opportunities, of course, in these markets. Wei Li, thank you very much indeed. There's plenty more coming up. Stay with us. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back. A redhead crossing the Bloomberg terminal right now, and an update in terms of Ghana's negotiations with its creditors. Ghana has come through with a deal in terms of restructuring its deal with Eurobond holders. This has been confirmed. The details coming through then. Ghana's bondholders will forego about $4.7 billion of their claims. This is according to the government of Ghana in a statement. It's an agreement in principle, and it entails important concessions from bondholders. Again, according to this statement, it also provides debt relief to the government of Ghana. So that's an update in terms of the negotiations between Ghana and its creditors, coming to a deal on restructuring around part of that Eurobond debt. Coming up, investors are on edge over the French elections. We're going to take a look at how traders are navigating the risks as the most recent poll suggests further upside for Marine Le Pen's party and more pressure for the party of President Macron. That is coming up next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers. It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Welcome back. Markets post modest gains here in Europe. US futures point higher as well. A big week, of course, in terms of political and inflation risk with elections, a US presidential debate, and the Fed's preferred price gauge all on the agenda. Bloomberg's poll, the poll shows Marine Le Pen's far-right national rally making further gains over President Emmanuel Macron's party ahead of the first round of France's snap elections. Plus, UK Business Secretary Kemi Badenoch and Shadow Business Secretary Jonathan Reynolds go head-to-head in a live debate right here on Bloomberg 10 days before Britain votes in the general election. Good morning and welcome to The Pulse. I'm Tom Mackenzie in London. Before we get to UK politics, let's go to France, where the latest, of course, suggests there are further gains for the national rally, further gains in terms of the polls, of course, ahead of the first round of the parliamentary elections on Sunday out of France. According to Bloomberg's poll of polls, the party is now on more than 34%. That's the national rally, the party of Marine Le Pen, of course. Meanwhile, investors are on edge over the prospect of a change in the balance of power. Bloomberg's Julien Pontus has more on that, but first, we begin with the politics, and Bloomberg's Caroline Cornat joins us with the details. Caroline, Macron trying to explain his decision to call the snap election that has injected so much uncertainty into the body politic of Europe and the markets.
That's right, Tom. And in fact, 2 weeks after he called those snap elections, many within his own troops still don't really understand why we are there, why we are 1 week before a first round of a legislative election in France. And even within his own camp, in fact, a majority of MPs running again for his party, Renaissance, have chosen to not have Macron appearing on their campaign leaflets and instead have the current Prime Minister, Gabriel Attal. So this kind of shows you the extent of this kind of not understanding within his own troops. Over the weekend, he tried to explain his choice once again, saying that he had no choice and we had to change the way we govern. And he was not blind, but conscious of the democratic malaise within France. He was talking to a regional press in a letter over the weekend. And he knew he couldn't keep going with using this 49.3 constitutional provision, which means bypassing parliament when you have a big reform. That's what Elizabeth Borne, for example, had to do to pass the pension reform. He knew he couldn't keep going like this, but he said again, trying to reassure the market that he will remain president no matter what happens on July 7.
Caroline, what, meanwhile, do the polls tell us about his fortunes as we count down to the vote, the first round on Saturday?
The national rally of Jordan Bardella is actually increasing its lead in our Bloomberg poll of polls, 34.2%, followed by the New Popular Front, this union of the left, at 28.2%. And coming third, you have Macron's Renaissance Party at 20.6%. So the likelihood is that we're going to end up with a scenario where Macron will have to share power, likely with a prime minister from either the National Rally or the New Popular Front. That's what we call in France a cohabitation. That hasn't happened since 1997 with Jacques Chirac and the socialist prime minister Lionel Jospin. Now, this week will be eventful. Before the first round on Sunday, we have Jordan Bardella actually doing a press conference in half an hour from now. Then we're going to have the first debate tomorrow night on TF1 national television between Gabriel Attal for Macron's party and between Jordan Bardella, of course, for the National Rally, and Manuel Bompard for the far left, even though Gabriel Attal has actually asked Jean-Luc Mélenchon to replace the far left in this debate because he knows that Jean-Luc Mélenchon is a turnoff for a big part of the moderate left-wing electorate. Now, that debate is going to be interesting given the cost, the spending that we've heard from the New Popular Front on Friday. They're planning 25 billion euros in spending just for this year, then 90 billion euros a year until 2027. And they're planning to finance all this with measures including reinstating the wealth taxes and perhaps even introducing a 90% tax on top marginal tax rate for income above $440,000. The last time someone tried that was François Hollande in 2012 with his 75% tax on income above 1 million euros. That was blocked by the Constitution, and at the time, Emmanuel Macron himself said that this would have meant France, this would have made France like Cuba without the sun.
Okay, Caroline Cornin, thank you very much indeed. Yeah, you'd imagine there are some sitting in the financial heart, La Défense, of course, in Paris, who might be sweating at the prospect of 90% taxes. Caroline, thank you very much indeed. We stay on this story because French banks, highway operators and utilities have been at the forefront of a $240 billion sell-off on the Paris bourse. The CAC 40 is actually posting pretty decent gains so far in the session, and sovereign debt of France is also bid modestly, of course, after the sell-off that we've seen. Let's bring in at this point Julien Pontus, the Bloomberg's French equity markets reporter in Paris. Julien, what is at stake then for investors?
Damage control. There's no upside scenario from here. It's really about how you can protect your investment. So you have two types of investors I'm speaking to: people who need to be invested in France, say a French manager selling French equity exposure, and those who can arbitrate between different geographies. The one who can go basically a lot of them have capitulated, so they went outside of France, in Europe, in the US. Some are being more aggressive and are shorting the CAC 40, for instance. Those who need to stay in France, because that's what they do French equities, they basically sold off banks, they sold off utilities, they sold off concessions, motorway operators. There's a long list of companies that are being sold, and there's very little companies that are being bought. What people are trying to do basically is figure out the companies that had the biggest footprint outside of France, like industrial companies who make, say, 80–90% of their sales outside of France, and they're putting their money in there. But it's a very tricky situation for investors.
What are some of the other adjustments that you're seeing that are kind of consequential amongst the investor base at this point?
French debt. A lot of people just won't touch it anymore. They don't see the upside. Whatever happens on July the 8th when the Paris stock market opens after the election, it's a very big stretch to see any rebound, a substantial rebound. There will be more uncertainty. There will be less visibility. We're really in uncharted territory here, so it's really a stretch to see any rebound from here. So if you need to be invested in France, there are a few strategies. As I said, like you would find them more global companies, you would invest on that. But if you're, say, a Brazilian or a Japanese investor, I don't see them buying the dip.
In the meantime, of course, we're counting down to the first round of votes and the first round of this election. This weekend, we have that debate that Caroline was talking about. What else are markets looking at? What are they monitoring as they try to adjust as best they can to this, as you say, pretty unprecedented political backdrop?
So some brokers, are saying don't go into the French market between now and the results on July 8th, basically. One big risk is that you could have a wipeout of Macron's party on the first round. So maybe you would have more visibility come Monday morning, and basically there will be no doubt that for instance, that Macron's party will lose, and it will be between the far left and the far right. That that would be, and it's likely it will be, a very volatile period for markets. I mean, the last week before the second round. So yeah, I would expect a lot of volatility within these 2 weeks.
Okay, Julien Poutus, Bloomberg's French equity markets reporter in Paris. Thank you very much indeed in terms of how French and international investors are adjusting to the political risk of France as we head up to that first round, of course, on Saturday. Thank you. Coming up, China and the EU agreeing to hold talks on the bloc's plan to impose hefty tariffs on electric vehicle imports. Automakers in the Eurozone getting a bit of a lift on the back of this news. We discuss the details next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Get excited about, because I'm a labor economist by training, and I think a lot about the distribution of opportunities across the nation and the world. And I think of AI as potentially being a great leveler, leveling the playing field, democratizing the expertise by giving people a hand up or a leg up in terms of starting.
San Francisco's Fed's Mary Daly there on AI creating opportunities in the labour market. Now, Beijing and Brussels have agreed to start talks on the EU's plans to levy tariffs on Chinese-made electric vehicles. Let's bring in our Global Autos editor, Craig Trudell, then, with the details. Joining us out of Oslo this morning. Craig, why, after deciding to put tariffs in place on Chinese EVs, is the EU now agreeing to hold talks with China?
Yeah, the EU really approached this differently, at least, in their view, and I think in reality, than, say, Washington did, or even we've seen other countries, including Turkey or Brazil, put in place higher tariff rates on electric vehicles, really out of concern of the amount of volume coming out of China and flowing into these other markets. And I think there's a real effort and has been, really since these were implemented, to sort of, differentiate and to lay out the case for, hey, we went out at this with a months-long investigation to get to the bottom of just how much, subsidization has been applied to this industry, and really came up with, you sort of did the math essentially and are showing our work in terms of, just how much of a tariff needs to be put in place company by company based on how much support they've had over the years.
So that will be part of the message that EU officials will bring to their Chinese counterparts. What else are they going to be using in terms of this discussion, this debate, this negotiation to try and put pressure on China, to try and push through some accessions at least?
I think, you know, I would assume that there is going to be, you know, some sharing of some of the particulars around this investigation to kind of, you know, lay out the case for why these tariffs have been put into place. There's also, I think, you know, going to be a desire on the part of folks on the Brussels side to really try and limit the extent of sort of return fire, if you will. So there's already been, you know, threats made of putting tariffs on imported vehicles with large engines. That's a big concern for the Germans in particular. Volkswagen and Mercedes and BMW are very worried about that. But also beyond the auto industry, I mean, you know, the threats being put on, you know, everything from dairy to wine to French brandy. So this has the potential to, you know, become something much more than just a trade fight over cars. There is, you know, a concern that this boils over into something much more, and that there's more of a sort of back and forth tit for tat here, along the lines of what we saw, you know, during the Trump administration between Washington and Beijing.
Well, Craig, what is your assessment of the propensity of Chinese officials to go full force on this then, in terms of the reality, in terms of actually putting in place restrictions to try and essentially punish the EU over this? What have we been hearing from Beijing in terms of their potential response?
Yeah, I think our executive editor, John Liu, spoke to this earlier this morning, Europe time, about this idea that, you know, in China, there's going to be a desire to really sort of, you know, get some concessions here, show that they've been tough on Brussels and you know, extracted something for their companies. I think, you know, in Europe and you know, hiring workers in Europe to make electric vehicles and batteries. One of the big concerns that you hear from Brussels and Washington is about the extent of overcapacity in China. So even if there is some on the margin, you know, investment outside of China, what is going to be done about the fact that there are so many car companies and battery companies producing so many vehicles and batteries? And you know, to what extent can the rest of the world even, you know, possibly compete when you know, they're working with workforces that are paid more and sort of undercut by the fact that China just has so much capacity and such an advantage in terms of price.
Okay, the overcapacity issues and risks emanating from China and how to address those. Our Global Autos editor, Craig Trudell, thank you very much indeed in terms of the latest on that front. Now to some other stories making technologies from hundreds of millions of consumers in the European Union. The company announced on Friday it will block the security and place user privacy and data at risk. Beijing-based ByteDance and US chip designer Broadcom have discussed a potential collaboration on an AI processor. That would help the TikTok parents company development of that technology. Bloomberg has learned a 5-nanometer purpose-built chip was discussed. Reuters has reported the proposed chip would comply with US trade restrictions on China. And Prosus and its parent company, Naspers, have posted its first ever profit. This as a new chief executive officer prepares to take the helm in July. The e-commerce business, which excludes the Tencent stake, reported a full-year trading profit of $38 million as it managed to scale its business after years of investment. Coming up, former UK Chancellor Philip Hammond calls Reform leader Nigel Farage a Russian apologist for saying that Moscow was provoked into war with Ukraine. More on that story next. This is Bloomberg.
when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
For that interview, of course, with the former Chancellor, the former Defence Minister as well. Strong comments on Farage. What did you make from what we heard from the former, again, Defence Secretary, which I think is important, and Chancellor of the Exchequer?
Yeah, of course, he was Defence Secretary at the time of 2014, you know, when these problems were happening in Ukraine. He was also Foreign Secretary as well and Chancellor, so really interesting to get his take across the suite of policy being debated in this election. On Nigel Farage, he says that you need to consider the threat that he actually takes over the Conservatives after the election if there is a merger with Reform, although he didn't see it as the most likely possibility. We also talked to him about the accusations that some members of the senior Conservative Party have been betting on the date of the election, essentially insider trading. And he said the rot set in with Partygate under Boris Johnson. He actually drew the same parallel that Michael Gove, the cabinet minister, made between Partygate and Gamblegate as it's being described. And it's interesting because polling shows from YouGov that actually Gamblegate is cutting through to voters and it's threatening to dominate this last stage of the campaign, which is not what Rishi Sunak wants to hear. And yet, as Lord Hammond said to us, it's not healthy for the Conservatives to be reduced to a rump. You really need a strong, coherent opposition. But if the polls are correct, it doesn't look like that's what the Conservatives are going to amount to.
Any chance they can change the narrative with the debate that's going to happen here at Bloomberg, 12:30 p.m. UK time, business secretaries and shadow business secretary taking each other on?
Yeah, I'm very excited for this. We've got Kemi Badenoch versus Johnny Reynolds for Labour. And this is a really important moment, Tom, because the political consensus is that growth, economic growth, is crucial and business crucial to that. So we're going to have questions from the big five business lobby groups here. It'll be interesting to hear what their pitch is to business, how you fix the skill shortage without serious investment in education or a bit more migration, where they stand on Brexit, the elephant in the room of this campaign, what their long-term strategy is for the UK, for AI, for planning, for industrial strategy, even if it's not very sexy, and finally, how you reignite investment into the UK, whether you are going to be picky about if that investment comes from the likes of the Middle East and China.
OK, so there's a lot on the docket. In terms of the challenges, just briefly, facing whoever is in power after that election, July the 4th, talk to us about just what the picture is showing us in terms of the economic challenges.
Yeah, it's really interesting to look at the misery index. This is something that was created in the 1970s. It brings together inflation and unemployment, and it shows that the first 18 months post-election, you're actually going to see more concerns about people not having a job because of that strong underlying wage growth. So a different problem problem to what Rishi Sunak's faced. And it comes back to what Philip Hammond said. You know, anyone who tells you that you can have tax cuts and improve public services is not being straight with you. This is the fiscal dilemma.
Lizzie Burton, our UK correspondent, thank you very much indeed. And as we've been discussing, UK Business Secretary Kemi Badenoch and Shadow Business Secretary Jonathan Reynolds will go head-to-head in our live televised debate, moderated by Bloomberg's Anna Edwards. Viewers in the UK can catch the business debate at 12:30 p.m. UK time today on Bloomberg TV. Up next, Bloomberg Brief. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranney. You're welcome to Bloomberg Brief. Let's set that agenda. Markets' attention shifts toward the end of the week with the first U.S. presidential election debate, and inflation data hits the deck. Tech firms race to team up. AI partnerships are said to be brewing between Apple, Meta, and Google, ByteDance, and Broadcom. And China and the EU agreed to hold talks on tariffs around electric vehicles. A very good morning. You're going into week number 4 of gains for these markets. Over 18 billion shares changed hands in the triple witching. That's about 55%, double nickel higher than the average over the past 3 months. But I bring you to the one beautiful phrase from Ed Yardeni. There's NVIDIA, by the way. Your morning check, down by 0.6%. It lost $220 billion in value in the space of 2 days, down 6.7%. It's merely a fissure. It is not a flesh wound. But I bring you to Ed Yardeni. It's the roaring 20s, baby. We're not scrambling to upgrade our targets. They go for 6,000, easily slotted in for the end of the year, the end of next year. They're going for 6,500. But by the time you get to 2030, they're looking at 30,000. No, they're not scrambling. When it comes to the other deals out there, Broadcom and ByteDance, we understand, are getting together to develop a new AI chip. To the bond market, it's going to be about the issuance. How much appetite is there for 2s, 5s, and 10s, a total of $183 billion in new issuance. But it all comes down to the bulls being ravaged by self-doubt. And they're going to need the PCE to come in on Friday at around 0.1% to embolden this trade below 425. When you're ravaged by self-doubt, why would you pick up duration at this stage? So pretty reasonable size of issuance to come this week. Dollar yen, again, back in the danger zone. The danger zone is around the 160.17 area. That's where they That's where they intervened before. And again, this is just a prevarication. The Vice Finance Minister, Kanda, has made it very, very clear. Excessive moves, and we will take the appropriate action. So that is your sweep of assets as we kick off this Monday morning. But as we head into the second half of the year, markets are now at a crucial point. Jerry Fowler of UBS, my next guest, says this: we don't see extended positioning broadly, although some of the AI stocks are very crowded. Well, that's stating the obvious. The low correlation, volatility, credit spreads environment is fueling plenty of appetite for risk. He joins us now. Jerry, good to have you with us. So, I mean, a fairly bullish footing, one could say. I've got different calls for 6,000 on the S&P 500, and I've just reminded our audience of what Ed Yardeni said, reminding us it's the roaring 20s, baby. So what needs to stay in place to deliver this pro-risk appetite that you've got? Good morning.
Yeah, good morning. Thanks very much. Well, what really needs to stay in place is that we continue to see what looks like a versioning Goldilocks, that inflation comes down and that allows rate cuts to alleviate some of the pressures that parts of the economy are feeling, and that happens before we start to see more negative consequences of higher for longer rates, that we don't have a credit cycle, in which case this will feel like a very large, a very significant mid-cycle slowdown in a much more elongated cycle.
So how dependent are you on rate cuts? I mean, we can endlessly debate every Monday morning as whether it's 1 cut, 2 cuts, no cuts. I mean, it is nauseating, but how much difference does 1/2 cuts make in the United States of America? Because it looks like other central banks may well outpace the cutting ability of the Fed.
Yeah, so I mean, around the world, rate cuts will make some difference to the profitability of certain firms and households that have debt exposure or sensitivity to those front-end rates, very short maturity rates. But really, the other thing that it does is alleviates the risk to markets, which comes from inverted yield curves, because the valuation of equities is much more reliant on long-term yields, like 10-year yields, which are currently a lot lower than central banking rates in general. So to some extent, unless we get rate cuts, you may start to see investors start to worry about that negative carry and that much lower yield that they're receiving on longer duration. And if those yields were to rise, and especially in the US to rise up towards where those overnight rates are from the Fed, it would put a dent in the relative appeal of US equities relative to others, especially relative, in comparison to what you'd be able to achieve in relatively risk-free assets long term.
So you're in the United Kingdom. Obviously, politics is front and center there. Across the channel in France, we've got another poll, another poll showing Marine Le Pen extending her hold on the electorate. I've seen the flow out of Europe for 5 straight weeks. Some would say that the institutions were prescient, they were ahead of the herd, they got out before the bloodiness of politics came home to roost. You say there is a low contagion risk, and you consider French stocks a buying opportunity. Are you brave enough to buy French banks?
We are. In fact, some of the French banks have really become very discounted on what is primarily a reassessment of risk premium. Perhaps some of that is justified in that we came from a very low level of risk premia, and so some normalization may be appropriate. And in addition to that, as we head into 2025, there is some concern around fiscal contraction as countries like France and Italy might need to go into deficit reduction procedures. But broadly, the overreaction of the market to the French election in terms of raising the risk premia in Europe broadly does seem a little bit overdone to us. If you look at the premium of European volatility to US volatility, it's back to levels that we haven't seen since prior to 2017 when Macron was elected president of France and ushered in an era of really quite similarly low risks between Europe and France. You know, this is back in the day when the Brexit vote happened, when there were lots of European crises on a rolling basis through the prior 7 or 8 years. And so that level of risk premium in Europe just doesn't seem warranted on anything other than a short-term basis while markets digest the potential election outcomes.
And again, let's circle back to probably where we started, which is to talk. How much of that, Jerry, is to do with, look, man, we didn't crash into a tragic recession, or is it to do with, again, the narrative around rates?
Yeah, it's a little bit of both in that there has been a remarkably resilient performance of growth in Europe through what has been a war and an energy crisis. That still kept growth at zero or very close to zero in Europe for the last few years. But now that's improving. And as we're now getting ECB rate cuts, we're expecting that to continue to improve. In fact, we'll probably go from about 0.5% growth this year to about 1.5% growth next year. So there's this nice improving trend of growth. At the same time, you've got disinflation and rate cuts that will, hopefully bring yields down as well and allow valuations to re-rate. So all of this points to an environment of reasonably low risks, quite low tail risks in Europe in comparison to the last few years, which really justifies at this point the valuation of the European market being north of 14 times forward earnings, and that sort of puts you somewhere above 540, potentially up to 570 if you get up to a very benign Goldilocks scenario in a European recovery. It's not to say Europe's without risks, especially going into 2025, but those risks have really dissipated over the last year. The worst case scenario isn't happening, and we're going to get rate cuts before we get a credit cycle.
Okay, Jerry, thank you very much for joining us, setting up the risk agenda this Monday morning. It is all about the shape of those yield curves and perpetuating risk here in the US. Jerry Fowler of UBS. Other stories trending on your Bloomberg terminal as we sit down for Monday morning. Israel's winding down its Gaza operations as the focus shifts to Hezbollah. China's fiscal income drops at the quickest pace in more than a year, and Bitcoin extends the drop after one crypto's worst weeks of 2024. Coming up in the show, China and the EU agree to hold talks on the bloc's plan to impose hefty tariffs on electric vehicles, on the electric vehicle imports, I should say. More on that story next. And a little bit later in the hour, we catch up with State Street's Marvin Lowe on why the Fed will continue its higher for longer campaign. It's different this time. Context matters on Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Monday edition of Bloomberg Brief. I'm Manus Cranny in New York. China and the European Union have agreed to discuss the bloc's plans to impose additional tariffs on Chinese EV imports. They include taking levies to as much as 48%. Now, this comes as the German Vice Chancellor, Robert Habeck, wraps up his trip in Beijing. For more, let's bring in our trade czar, Brendan Murray. Brendan, good to have you with me again. I mean, tariffs are sort of, a byword for all nations' relationships with China at the moment. What is Habeck hopeful for from the European side? What's at stake here to try and de-escalate this?
Yeah, I think exactly. He's trying to sort of turn the temperature down and make this more of a consultation rather than a negotiation or, some sort of debate between the EU and China. There are two very different expectations going to come from these talks. On the European side, they're going to look at these as consultations, a very sort of low temperature way to explain to the Chinese how they came about these tariff levels, how these tariffs will have to comply with the World Trade Organization. On the other side, from Beijing, they're going to be looking to try to poke holes in the methodology that the EU used, and ultimately to try to take this time to divide and conquer the EU member states. Germany there's a lot of opposition to the EV tariffs in countries like Germany. Mm-hmm. So the Chinese side will try to exploit that and ultimately try to head off the tariffs when they're due to come into effect in November.
Yeah, and in terms of the Chinese side driving for this, I mean, what exactly are they want? I mean, we've seen spats over cognac, we've seen spats over dumping into China on that. There's been accusations on both sides. So if I said to you, well, what are the Chinese side driving for in this? What is it that they're bargaining for?
Well, you're gonna hear lots of threats about retaliatory efforts on European, as you mentioned, foods and liquor and anything that would sort of help grab a headline to various industries and electorates in the European across Europe. We've already heard some of those products, and the producers of those in Europe are already not happy about it. So. We're gonna see the Chinese. It's a replay in many ways of the solar industry's issues back about 10 years ago or so. That China has used that playbook before and probably will again.
Brendan, thank you very much, setting it up so eloquently. Brendan Murray there on the latest discussions between Germany and China. From EV to AI, Meta held talks, we understand, with Apple about a possible AI partnership. That's according to the Wall Street Journal. The company is looking to integrate its generative AI model into the newly announced Apple Intelligence, the holy grail, getting a hold of all those iPhone users. Tom McKenzie is with me. I was reading Dan Ives' note from Wedbush. The gatekeepers of consumer AI, that is Apple, and that is the ultimate driving force for these potential deals that we're seeing.
And that is exactly why you're seeing the likes of OpenAI, of course, signing a deal with Apple, and now the news, again, reported by the Wall Street Journal, that they are having conversations with the like of Meta. Interesting, given that Meta has had a challenged relationship. It relies, of course, on Apple's hardware and platforms, the iPhones and the iPads, in order to get its apps out there. But we know that they've had a challenged relationship in terms of what Apple's done that has restricted their ad revenue in terms of the targeted advertising part of the business. But they're having these conversations, again, according to reports. Meta has its own models, the Llama models. So it's about integrating those models into Apple's products. The reporting as well from the Wall Street Journal also suggesting they're having conversations at Apple with the like of Perplexity as well as Anthropic. So they're keeping their options open, but as you say, this would, on one level, be a massive gain, you would have thought, for Meta to have access and get its models into the hardware of Apple and all of its products.
Yeah, I mean, just looking at some of the data, 2.2 billion iOS devices, 1.5 billion iPhones, Tom. So you begin to understand then why, for example, Wedbush are saying, look, over time, you're looking at a $10 billion trickle-back effect to Apple. Let's talk about the other narrative, which is around the world of chips, the one that you know well. Great videos, great Instagram. If you haven't seen Tom and his big board, you got to tune in for it. They've got all the resources in Europe. I've got an iPhone and no light. Yeah. You get an entire studio. Just saying.
Yeah, we need to get that fixed.
I'm just saying, Tom. Just saying.
Yeah.
Maybe you can
there's a discrepancy there, isn't there?
Maybe you can let me into your studio when I'm there in a couple of weeks. Let's talk about ByteDance and Broadcom. This is an interesting alliance given the geopolitical stance at the moment. ByteDance, Broadcom, America, China developing an advanced AI chip. This is according to Reuters. Of course, this is all going to be within the rules that the US set in terms of those relationships. But what is this deal, this potential deal?
Well, look, you hit on two really important aspects, which is the context and the caveats around this. It will be compliant with those US laws in terms of what you can ship to the Chinese market. But you're also absolutely right to suggest that this is pretty counterintuitive, that Broadcom would want to be doing this deal, that would be risking this deal. Some might put it as a potential risk for Broadcom, working with the parent company, of course, of TikTok, ByteDance, in China to build out 5-nanometer chips. They would be designing them, Broadcom would be, and then TSMC over in Taiwan would be crunching them out and producing them. Again, according to the reporting from Reuters. And again, to stress, they would be compliant. But those rules, we know, change, and they change fairly rapidly. We're leading up to that election in November, arguably potentially exposing themselves here, Broadcom. But also, I guess, the upside would be they'd have another significant client in the Chinese market.
And then let's just round off. Apple, never far from an EU warning. Now, this is, again, going at them again over their music apps. And it's not the first time, is it?
Yeah, look, this is a scrap that continues between the EU and Apple. This time a warning from the authorities, from lawmakers in Brussels, saying that they have to allow the developers of apps on their platform, on the App Store, to recommend to their customers that they can get deals outside of the App Store. Also, a warning that they're looking at the fees charged to those developers of those apps within the App Store. So those two things coming in. If they're not compliant, this is all linked to the Digital Markets Act of Europe, which gives the regulators there these greater tools to pressure Apple. If they don't comply, ultimately, you could get to a point where they're being fined 10% of global revenues, ultimately, but before that, you'll get to a legal spat, no doubt, and this will work its way through the courts. But that is the potential implication for Apple at a time, and of course, it was just a few months ago when Europe slapped a fine on them of around 1.8 billion euros over the Play system, the audio system, I should say, Spotify and others, in terms of the App Store and how they've been treating those music streaming services. And then, of course, on Friday, Apple turning around and kind of playing their own card on this and saying, we're not going to be releasing our artificial intelligence products in Europe because of security concerns linked again to the Digital Markets Act. So the spat is continuing, ramping up to some extent between Apple and the EU.
It is indeed. You don't want to be left out of what's available in the AI world, certainly not on the productivity side. Tom, thank you very much. Tom McKenzie on Big Bad Tech this Monday morning. Coming up the show, I'll bring you the results of the Bloomberg poll and the French election. That's ahead of the first round of legislative elections this weekend. Context matters on Bloomberg.
names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
It's Bloomberg Brief. A very good morning. I'm Manus Cranny in New York. Front page news for you. This is what is making headlines around the world. First up, Reuters writes about U.S. prosecutors recommended the Justice Department criminally charge Boeing. The recommendation comes after prosecutors found the plane maker had violated a settlement related to 2 fatal crashes. Next up, the UK Financial Times writes the Conservatives have lost a third of their voters since January. The poll finds the survey said 32% of people who initially said that they would vote Conservatives had since changed their minds from the start of the year. And Bloomberg News, we have our new French poll of polls, which shows Marine Le Pen's far right keeps rising. Emmanuel Macron, his party, lags both National Rally and the leftist bloc. The polls are ahead of the first round surprise elections this weekend. Let's bring Julien Ponthus. He joins me from Paris. So here we are, again, I suppose a confirmation of what we already knew, which is that we're careering towards cohabitation, potentially in the French system. How are investors adjusting to this level of uncertainty? Good morning.
Good morning. Quite badly, to be frank. There's been a 200 billion and over that wipeout on the French stock market. And there's very little hope that there will be a rebound or very few investors buying the dip. There's been considerable stress on the French sovereign debt that has spilled over on French banks, utilities. There's been quite a big sell-off. And as you said, the polls that you mentioned, they actually, we're probably going towards a majority or a win for the far right, which is, uncharted territories for France. So, yeah, a lot of uncertainty and people are bracing for more volatility.
So between now and the second round, I mean, this poll seems to be solidifying around Le Pen and Macron dropping back. Very briefly, what do we expect between round 1 and round 2?
The big surprise, what will be really decisive is whether the centrist bloc can maintain itself for the second round. And, will we be in a situation on Monday, the centrist alliance or bloc will be wiped out and you'll have, a clear-cut far-right, left-wing bloc battle. That could, trigger a lot of volatility or,
Well, certainly 220 billion of a wipeout in equity is already a bit of volatility. Let's see where that spread goes to on the OATs against the Bloom. Julian, thank you very much. Julian Ponthos. Coming up on the show, election risks. Yes, you know they're there. State Street's Marvin Lowe will put the context around the uncertainty in global geopolitics.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
This is Bloomberg.
From our global headquarters in New York, I'm Manus Craney. Let's set your agenda. Tech firms race to team it up. AI partnerships are said to be brewing between Apple, Meta, and Google, and ByteDance and Broadcom. Market's attention now shifts towards the end of the week with the first presidential election debate and inflation data hitting the tape. And China and the EU agreed to hold talks on tariffs around electric vehicles. The off-ramp is building in that story. Let's check in on these markets for you. You've had 3 weeks of gains. We talked a lot about triple witching on Friday. And actually, 18 billion shares changed hands. That's 55%, double nickel higher than the average over 3 months. I want to remind you of what Erd Yardeni said. It's the roaring 20s, baby, and they are not scrambling to update their estimates. They're going for 6,000 by the end of the year, 6,500 by the end of 2025, and 8,000, stay invested, by the end of the decade. NVIDIA, it's your morning market check. NVIDIA down 1.33% now. That's adding to a third straight day of losses if it comes in on the cash, down 1.33%. We've wiped up $220 billion in value. Keep an eye on Broadcom. Broadcom and ByteDance getting together, the secret customer or the customer that was going to deliver the sauce, according to Broadcom, up 0.6%, developing the holy grail, their next advanced AI chip together. So that's on the stock side. The bonds, and look, bond bulls, they're ravaged by self-doubt. Every time we trade at 425, they're a hard lot to please. They need PCE affirmation by the end of the week. They need to see a 0.1% in terms of the disinflation narrative, but it's not going to be enough to juice a July rate cut. Maybe not. Marvin Lowe might have a different opinion. Issuance, 2s, 5s, 7s, $183 billion. I hope you're hungry for a few bonds and maybe some moderate duration in the belly of the curve. Dollar yen, it's getting risky. It's getting tricky. 160.17 is where the Bank of Japan intervened last. That was April 29th, we understand. The Vice Finance Minister has warned. Kanda has said excessive moves, and we will take appropriate action. So maybe that keeps a lid on the dollar at around 160. So what are we gearing up for? Well, it's going to be a week of both inflation data and the guide on bets for future interest rates. State Street's Marvin Lowe writes this: rate cuts to date have not been without surprises and drama. We like that. From the unexpected back-to-back moves from the SNB to cuts with reservations from it, remains clear that more cuts are coming as we enter the second half of 2024. We're lucky. He's got in the cab and he's joining me around the desk. Marvin, good morning. How are you? Good to see you.
Good morning. Nice to see you too.
So, look, the debate is, my last guest, Jerry Fowler, said, look, the reason why these rate cuts matter so is because of the shape of the yield curve, ultimately, and what that does to risk. Here we are, globally rate cuts are coming, but the betting seems to be that it will be the rest of the world, the UK and the ECB and the SNB, that will outcut the Fed. What does that mean for risk?
Well, you know, certainly the prospects of them outcutting the Fed within the short term is true. But longer term, a lot of these curves settle somewhere around the same, where, you know, by mid-2025, end of 2025, a lot of these cut curves do look somewhat similar. So the story is still there. The timing might be different, but you know, for a global macro guy like myself, if it begins in September, if it begins in December, it doesn't matter as much as long as there are 4 or 5 cuts that come after that in succession.
But you do warn on the cadence of cuts. You do warn that it's going to be a shorter cycle and shallower here in the U.S. than we perhaps presume.
I think in the U.S. that's probably the outlier story out there. You know, certainly we're seeing weakness around the rest of the world. We're seeing transmission of policy go into their economies in a way that makes more sense. In the U.S., the fact that we're still waiting for the cut cycle to begin just shows how different our financial system is here. And then, do we have sticky inflation? Do we have fiscal concerns that drive a curve that doesn't get as steeply cut as markets expect, and as the Fed expects, actually?
And we'll deal with politics a little bit more deeply in a moment. Okay. I mean, we've got a big piece of theater coming this week in terms of the Biden-Trump, the curtain raiser, round 1 in France. But I think the curtain raiser is probably the bigger issue. But here's part of the narrative that's come through with guests, which is leave the long end. They don't want to be exposed because of the fiscal risk of whoever sits in that White House next year. Yeah. Is that what makes you reluctant on long duration, but you'll take the belly?
Yeah, for sure. So long duration does reflect kind of that view in terms of how much term premium you need in the market. The belly is probably more affected by what the cadence of cuts are relative to expectations. So I could certainly see the market getting excited about cuts, but really once the dust settles, can it get as low as the market and the Fed expects? And already we're seeing signs that investors are really questioning whether or not the world after the pandemic looks like the world before the pandemic.
And you're squarely of the view that it doesn't. It's a different world in terms of inflation and in terms of transmission mechanism. We've seen that before. You mentioned term premium. Is there enough term premium in European bonds to tempt you towards there? You're neutral on duration overall.
Yeah.
But again, we've got UBS saying now is the time to be brave in terms of French assets and perhaps in duration there. Do you share that level of discount value?
I mean, so many idiosyncratic stories that are out there. It does feel as if the widening of oat spreads reflects a lot of risk, if you will, particularly when the risk isn't around redenomination. It's more around how the French budget evolves, how the French relationship with the rest of the EU evolves. But in terms of thinking about, are they going to leave the Union? Is this going to fracture the EU? I don't think that's part of the story now. And there is a lot of term premium around those types of concerns.
And that's what Le Pen came out really and tried to push back against when she talked about chaos was being caused by Macron, that she was not in the business of causing chaos.
And also, politics do have a tendency to not be as extreme as us analysts like to talk about in the beginning. She wants the presidency in several years also. And really breaking up, if you will, breaking a lot of things probably doesn't help that cause ultimately. So I always keep that in the back of my mind and thinking how this might evolve.
We were sat together briefly for a couple of moments earlier, and I said to you, well, politics will matter and debt sustainability will matter even more. And do we need a throwaway statement, but I want you to bring it to life on air. I said to you, does the US bond market need a Liz Truss moment to invoke some kind of fiscal discipline in this country? And what I'm saying there is that neither party, neither Biden nor Trump, would appear to have fiscal prudence as one of their top priorities, and this is part of the reason why people don't want to take that long duration in the United States of America. Do we need a Liz Truss moment in the U.S. bond market?
You know, I don't think so. I think that we already have so much debt to begin with, and based on some of the budget revisions that we got last week, we're going to have even more debt. The buyer group is becoming more narrow. You know, certainly the U.S. has lived on the generosity of its neighbors for decades now, and the exorbitant privilege has given us that ability to. But China, they're not going to buy as many bonds as they have in the past. They don't need to. Other foreign governments, ironically, the emerging markets have been the most fiscally responsible of the governments, if you will. They don't need dollar reserves the way they used to. And ultimately, with the amount of debt that you have, you need other buyers to step in. And those buyers are more price sensitive. The mutual funds, the insurance companies, the pension funds, if you will. They're not just going to buy because they need to fill a certain percentage. They're going to buy because the price is right. So we don't need a Liz Truss moment to really get the focus on the U.S. bond market. It would certainly accelerate it. I think that there would be a lot of carnage. You know, I don't expect that because the depth of the U.S. market is so big, but the long end could underperform, which is really what I'm looking for once we realize that the cutting cycle is not going to be as deep as it is.
Quantify underperform.
You know, I could certainly see a 5.5% 10-year going to 6%. So you wind up with a bear steepening curve, even though we are in the midst of a cutting cycle.
And just put framework around that for me. 5.5%, 6%, Marvin, between now and the outcome of the election, Manus, or now into next year when there's a fiscal?
It's more of a mid-25 into the end of 26. The tailwinds associated with the cutting cycle are very, very powerful. We've seen that. Even though we're talking about where this all winds up, bonds have rallied fairly aggressively. So, you know, I wouldn't want to bet against that. I wouldn't want to go overly long duration with those concerns, but once we start cutting and we realize we might not be able to cut as much as expectations, then the spotlight goes on, well, what's term premium, what's inflation volatility, and really what's the supply and demand factors around debt.
Okay, Marvin, great context. As you said, those bulls, they're ravaged by self-doubt. Got a chuckle out of you on that. They'll be even more ravaged, they'll be even more provoked with self-doubt after listening to your calls. Marvin, thank you very much. Marvin Lowe setting the agenda this Monday morning in the bond market. And let's talk about debt capital markets now. Mizuho's America's head of banking says she expects more activities to come through the election season. Michal Katz sat down and spoke exclusively to our very own Shonali Basak. Let's take a listen.
We've absolutely been seeing rebound across M&A, private equity LBOs, as well as some dribbling into the IPO markets. But activity in 2024 has not panned out as expected. Most of the activity has been highly concentrated. When you think about the M&A side of the world, 40% of M&A activity has been with mega transactions, whether it be in the energy space, TMT, financial institutions. On the LBOs, we've certainly seen some of that. But when you take a look at the broader M&A volumes, private equity has still, I would say, on the sidelines, constituting 25% of overall activity compared to the 35-40% that we've seen in recent years. So certainly a rebound, but there's a lot more pent-up demand. There was a Bain study that came out and said that there are 28,000 portfolio companies sitting in private equity firms, 40% of which are 4 years or older. So there is clearly, I would say, demand to monetize some of those. Also, as we know, private equity had raised massive funds, which they have yet to deploy. So we're beginning to see some early days of activity, but hopefully there'll be more to come as we get through the elections and beyond.
The 28,000 companies there that are ripe for exiting, is that how you look at the potential base of future clients?
Part of the base of future clients. As I mentioned earlier on, we do focus on publicly traded companies, which have been very active participants in deal activity. They're well capitalized, and there is an opportunity for them to achieve synergies in pursuit of growth, innovation, as well as consolidation. That's one area. Second is the private equity world, which we just talked about. But let's not forget that there are also 1,400 unicorns in addition to other cohorts of companies that have been funded by the venture capital community, which are similarly looking for an exit and what has been a rather muted IPO market. And so when we take a look at what is the potential client base, it does span companies all the way from the venture side, or I would say growth venture, to the private equity, as well as publicly traded companies, mid-cap as well as large cap.
Zoho America's Michal Katz speaking exclusively to Bloomberg's Shonali Basak. Context matters every day on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranny in New York. China and the EU are agreeing to discuss the bloc's plans to impose additional tariffs on Chinese EV imports, including taking the levies to as much as 48%. Now, this comes as the German Vice Chancellor, Robert Habeck, wraps up his trip to Beijing. For more, let's bring in our trade czar, Brendan Murray. Brendan, Habeck is hoping to deliver an off-ramp for the European side here. What do we understand has happened?
So what we think is going on is that China, between now and November, when these tariffs are supposed to take effect, is going to put the full court press on EU members to try to get them to back down. Now, that could be a divide and conquer kind of strategy. It could be, offering incentives. We'll build plants in Europe if we have to. But for what we're going to see is a real high stakes game of geopolitics between now and November.
And on the Chinese side, where are they? They're locked out of America in terms of the tariff regime here on EVs. How important is Europe to them? I mean, in terms of expanding and growing the EV business for them, what is it that they're going to be driving for?
Yeah, I mean, it's Europe is the whole ball game for China right now. As you said, the U.S. is basically locked Chinese EVs out of the market, and if they can't sell into Europe, there's going to be a lot of surplus electric vehicles made in China dumped into the world economy. China's making some headway in Latin America. We've seen some figures come out this morning that shows that they really are selling at almost triple-digit. They're exporting at triple-digit rates to places like Brazil. So, but the real kind of crown jewel in the global economy at the moment is the European economy. We've seen BYD dealerships open up in the UK even. So if the tide starts to turn against Chinese electric vehicles here in Europe, then it spells big trouble for that important industry in China.
Brendan, thank you very much. Certainly the automakers reacting a small amount in Germany this morning on the back of this, so there may be just a little bit of an opening of discussion. Here in the US, we've got the first presidential debate between President Biden and the former President Trump. It's scheduled for Thursday. It will be in Atlanta. Joining me now to break down what we can expect is Kriti Gupta. Kriti, good to see you. I'm just looking at Politico here. Trump taking broad swipes at Biden, being held up in Camp David over the weekend to prepare for this. I mean, disparaging, to say the least, in terms of the moderators, Dana Bash and Jake Tapper. So how much and how important will this first debate be? Who's got what to win here?
Well, it's all about clarity, Manus, because a lot of the policy agenda, at least critics of it, have been that their policy agendas aren't actually that different, specifically when we're talking about how they're dealing with the rest of the world. Both presidents, President Biden and President Trump, have talked about increased or decreased NATO spending, for example, and having Europe pull up more of its weight, getting to that 2% of GDP target. They've both talked about being tough on China in different ways, bringing some of that international manufacturing capacity, specifically around chips, onto U.S. soil. They've just done it in very different ways. For a financial audience, Manus, I think what's important to keep in mind is you're also hitting a budget deficit ceiling. That's really important. It's the first thing on the president's docket. So when people are going to be parsing for is, one, the tariff story. What does that look like under whoever becomes president next? And second, how do they fund it when the deficit is only growing?
And how much will immigration play in this debate? Again, Trump over the weekend, a number of sort of highly speculative things that he suggested, talking about immigrants again and talking about a championship fighting league for immigrants. I mean, it's sort of very inflammatory language. Will it play hard on the agenda?
This may be the make or break moment for both presidents, actually, because it is such a hot topic issue in the States for a variety of reasons. Now, this isn't just an immigration story relative to the southern border. This also has to do with things like H-1 visas, for example, student visas to international students, specifically coming out of India, China, for example. What does that workforce actually look like specifically in the tech sectors? Not to mention the manufacturing one. Of course, to your point, Manus, this is going to be a really big issue. It's also going to feed into how a lot of economists view the labor market story, especially when it comes to the Federal Reserve. That could be a game changer in terms of just how much support the labor market actually has.
Okay, Critty, all eyes down. There'll be a lot of speculation between now and when that debate actually hits the airwaves. We'll be watching it. We'll be glued to it. Critty, thank you very much, Critty Gupta, on the upcoming election debate. Nice sports story for you now. We've got Tiger Woods. There's a vehicle that he has. It's called Tomorrow Sports. It's been valued at $500 million. The co-founders, you got Tiger Woods and Rory McIlroy. They've just secured funding from Dynasty Equity Partners, and the company's first project in this partnership with the PGA is for an indoor golf league known as TGL. That's going to be scheduled for launch in January, and it will air on ESPN and ESPN Plus here in the United States of America. The capital injection will fuel expansion into new formats, leagues, territories, and media properties. Of course, I mean, you know, the picture that you've got there is a trio of smiling people. I'd be smiling if I got $500 million in backing from equity investors. Let's talk to you about markets, whether this roaring rally can continue. As Ed Yardeni says, it is the roaring 20s. You've got equities a little bit better flat this morning. And bond market, you've just heard from Marvin Lowe there from State Street, in a scenario where you could see yields going back to 5.5%, 6% in bonds. That's from State Street this morning. Playback for that conversation. And the dollar trades down 1/8% this morning. A lot of talk about potential intervention on dollar yen. Good morning. Coming up, we will talk about that presidential debate. And of course, the bond bulls. They want to see what the inflation data is at the end of the week. Context matters on Bloomberg. Good morning.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Bloomberg Brief. I'm Menace Cranny in New York. A look at the rest of the week. This is what we've got for you. San Francisco Fed President Mary Daly. She'll speak at 2 p.m. today, Eastern Time. Thursday, it is that all-important piece of theater. It is going to be the Trump President Biden and former President Trump go head-to-head in their first presidential debate, and then we get the second round out of the way. I'm talking about the PCE. The numbers will come through as well for personal income and spending on Friday. That's going to be critically important to the bond market. Some micro movers for you. You've got Coinbase. Crypto-linked stocks under a little bit of pressure here. Bitcoin is slumping and has been under pressure. You got RXO jumping. They've agreed to buy UPS's brokerage business, Coyote Logistics, for $1 billion. But the macro mover of the week will be where the bond market goes. 425 is perhaps the most difficult level for the bond market to keep its attention at. As you can see here, we're at 425 at the moment. We just had Marvin Lowe from State Street talking about the lack of term premium in these markets, and he can see a confluence of events that can take you through to around 5.5–6% next year in the bond markets. What you have here is a bond market ravaged by self-doubt. They need the PCE to come in at 0.1% again on a consistent basis, but nobody believes that July is the open month for a rate cut. You've got $83 billion worth of bonds, 2s, 5s, and 10s all coming through this week. So we'll keep an eye out on that. That was your Monday edition of Bloomberg Brief. A lot of food for thought from UBS saying now is the time to take advantage of the deep discount in French assets, including the banks, and Marvin Lowe warning you, a prescient warning, that yields could re-spike when the market realizes the Fed can't cut just as much. Context matters on Bloomberg. Good morning from New York.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
the first time this year, the market is starting to get nervous about the potential or higher probability of some sort of harder landing.
All equity markets are at a risk simply because you are at the point where the unemployment rate in the US is very low, is starting to pick up.
It's clear to me that we're going to see slower growth over 2024 relative to 2023.
That's only a couple months ago where the narrative was re-acceleration even, but I think the data now have more clearly slowed.
The market is expecting this slower growth and inflation outlook. That doesn't mean that you're going to have a hard landing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It is a new trading week, and it is the start of the end of the first half. Good morning. Welcome back. Anne-Marie Hordern, Danny Berger, Lisa Abramowitz, Sean Farrow still off until next week. We are looking at the end of the first half that is ending with a bang. It is a three-part act. The first part is whether or not you could get some kind of broadening out of this market action, which we got a hint of at the end of last week. We get economic data, including the key core PCE data. And then, of course, it really heats up on the political front on both sides of the Atlantic. I want to start with markets, Danny. This idea of we saw the Russell 2000 outperforming in a significant way for the first time in a very long time as big tech lagged.
It's this, can the catch-up trade happen? A lot of folks thought it would happen to start the year. It still hasn't. The issue this time around, Peter Scheer lays this out really well, that you had this happening last time, that the data was improving and the rest of the market wasn't catching up. Now the data is not improving, but it's okay. Can we really play the catch-up trade in that environment?
And when you say the data is improving, sort of, or it's not that much improving, but it's okay, it raises the question of what's going to be okay, Anne-Marie, this week. We get core PCE, we get personal income, personal spending at a time where there's sort of this odd dance. Will people tolerate high prices? And is that a good thing or a bad thing?
Well, this is what is going to be so important on Thursday's debate, because Trump is going to come out and try to talk about how the economy, things, cost of goods, more expensive now than they were under his term. Paul Donovan this morning. Lisa, I thought of you the second I opened up his note. Quote, politics, sadly, is in focus. He talks about inflation, and he said it's one real-world issue that has political resonance, and he says inflation is an emotional issue, not a rational issue, which is why it's been so hard for the Biden campaign to explain that the rate of inflation is coming down. But that's just here in the United States. You brought up on the other side of the Atlantic, the first part of this legislative election kicks off in France on Sunday, and the economy, once again, the polls are showing that actually Macron is due for a bruising.
Okay, pause. A lot to unpack there. Danny, I want to just tell you that to Anne-Marie's point, I did look at this week and I thought, this week is all politics. Yeah. And as much as I don't want that to be the case, it is all politics, whether it's the debate that really kicks off the season. Earliest debate in modern history, right, between two presidential candidates. But Danny, then we get the French election that's caused spreads to just gap out between French bond yields and German bond yields.
See, this is the thing. I'm totally with you, Lisa. I usually would have looked at this week and said, the politics doesn't matter for markets. It's amusing is the wrong word, but it's the only word I got, and who cares? But you look at what's happened around the world, Mexico, India, France, Germany, it matters. It matters for markets, and it matters to an increasing amount. I mean, will the debates matter? Will we get anything about the deficit? Maybe if we do, that will move markets, but it's having an impact.
When you say the deficit, this is a reason why I care particularly about the bond auctions this week. I just want to say, I know everyone's
front
saying...
page of the FT this weekend, the weekend edition, front page is the concern about the fiscal risk. And looking into 2025, this is going to be a huge debate, because whether or not we get Trump or Biden, the deficit's going to go up.
Just to put that into perspective, $69 billion of two-year auctions tomorrow. You get $70 billion of five-year treasuries on Wednesday and $44 billion of seven-year treasuries. Just a state of play heading into the beginning of a new trading week. Last week, we got this sort of eking out of gains, but they really were led by the Russell 2000, up about 0.8% versus the simply flat performance on the NASDAQ. Today, you can see a bit of what basically ongoing flatness, lack of any kind of action, marginally up on the S&P. NASDAQ down just a touch. What you can see in Treasury yields just lower just a touch as we game out whether or not the economic data can continue to support that. That's on the 2-year. 10-year yields up higher, just marginally for 26%. In the euro, 107.22, just strengthening a touch after weakening to end the last, end Friday, basically below 107. As for the week ahead, today we'll get Fed speak from Mary Daly. Tomorrow, more Fed speak, plus the Conference Board's consumer confidence data and FedEx earnings. Wednesday, new home sales and earnings from Micron. Thursday is headlined by, as we were talking about, the presidential debate. We'll also get jobless claims, durable goods, and earnings from Nike. And Friday, more Fed speak, plus personal income and spending and the core PCE deflator. That, to me, is going to be really key, Danny, given the fact that people are talking about the potential for maybe things to come online with almost the Fed's expectations at 2.6%, getting closer to that.
I think the worrying piece in there, as we learned last week, is going to be housing. I mean, housing is still a pretty major component in core PCE, and we saw that housing starts weren't there. The supply isn't coming back online. It's still a sticky part. It's not coming down, and it is such a big source of personal inflation. So if you're in the scenario where the housing component is usually not coming back online, it's not playing ball, how can the Fed really be bullish about cutting this year?
All right, coming up, we've got Lori Calvasina of RBC with stocks coming off 2 days of losses. Terry Haynes of Pangea Policy as Trump's VP search comes into focus, and Citigroup's Robert Sotkin calling for a September rate cut. We begin with our top story, kicking off the final week of the first half with two stocks coming off 2 days of losses. Lori Calvasina of RBC writing this: the continued outperformance of mega cap growth stocks has been logical, but still somewhat jarring to us. Small caps broke to clear new lows relative to large caps last week, and investor sentiment continues to concern us. Lori, thank you so much for being with us. You're joining us now, and really I want to start with this idea that we're starting to see a broadening out. We're starting to see the small caps just begin to eke out some outperformance. Could this be the beginning of something bigger?
Well, thanks for having me on, as always, Lisa. Look, I would love to sit here and tell you I hope that that's the case. I think that small caps will have their day in the sun, and we certainly keep having these really good days in small cap relative to the rest of the market that keeps sucking us in. But if you pull up a chart on your Bloomberg and you look at the Russell 2000 relative to the S&P 500, just a relative ratio, we keep breaking to new lows. And even with some of the improvement that we've seen on certain days recently, you really haven't been able to abate that trend. So what's driving that? I do think that sentiment is already pretty washed out on the small cap space. If you look at CFTC data, you're back around regional banking crisis lows, the SVB lows, essentially. But if you look at other indicators, you really have to, first of all, attack what do you think is going to happen with the Fed? RBC is calling for a December cut. We still see other shops calling for something earlier. I really do think you need to get the cut figured out because essentially small caps don't tend to pre-trade cuts. They tend to outperform after the cuts happen. So any disappointment we get on that cut narrative is just going to push these stocks right back down. The other thing that you really need for small caps to work is an above average economy. And one of the things you guys were highlighting in the opening with all those clips is some nervousness that's starting to come back in, some squishiness that's starting to return on the consumer. And we're not really seeing a big reacceleration or a big upward revision to GDP forecast for this year or next the way we were at different times over the past 6 months. So those economic tailwinds that helped the rotation get started at certain points over the last 6-9 months, we're just not getting that right now. So I'm staying more neutral on this space. I like the positioning. I don't like the situation with the Fed, and I don't like the fact that the economic story seems like it's slowing a little bit right now.
So neutral on this space, but for much of this year, people were basically underweighting small caps and saying, keep going into big tech because it's a freight train and you can't get in front of it. Has that changed?
So, it's interesting. We've been talking about mega cap growth the last few weeks in our weekly, and I had one investor write me in and say, it just feels like these stocks are tired. Like it just feels like they're sort of on their last leg. And I was thinking about that at the end of last week when we started to see some rotation out. I think the problem that you have in this big cap growth part of the market and these kind of Mag 7, or Mag 1 type stocks, whatever bucket you want to take, is that growth rates are slowing from astronomical levels to things that are still pretty strong, but clearly a notch below what they've been. And what I've noticed just in the past couple decades that I've been doing this job is that whenever that happens, you just don't have as much of a margin for error. People get angsty. People are looking for reasons, looking for excuses to take some money off the table. And, I know there were technical things that contributed to the weakness late last week, but I do feel like that's something that is going on here. And that adds, if you kind of broaden out, yes, you could technically maybe get some rotation where the rest of the market doesn't do as badly. But I do think that contributes to kind of my nervousness on the stock market, just the sheer weight of these areas. And if they're starting to hit some air pockets, they're starting to hit some potholes, and people are kind of looking for an opportunity to take money off the table, that can have ramifications in the broader market.
Just on the sentiment for tech itself, Lori, we talked about on Friday the Marco Hartnett note from Bank of America that said that there were record inflows into tech. That's kind of being questioned whether it was just an ETF with some technical flows having to do with rebalancing. So given all that, can you just categorize the sentiment around tech and the positioning in tech? How stretched at the moment or not stretched does it look?
So I believe he's looking at the EPFR data on the flows. I'm not positive about that, but we do watch that data as well. We put it out in our weekly so you can sort of see the technology sector inflows. We look at a 4-week average because that data tends to be very, kind of lumpy and volatile week to week. And we have seen some big inflows going back to the tech space and the large cap growth space. But I tell you, Danny, if you look at the chart, it's like kind of parabolic. And it's one of those charts as a strategist. I look at it, it's gotten kind of close to past highs, and it looks like it's ripe for reversion. So I do wonder if we're going to get some confirmation that we're starting to see some outflows when we get the data updates over the next couple weeks. If you want to sort of put that flow data aside and kind of think about general sentiment, I would urge you to look at the CFTC data, which unfortunately I don't think came out on Friday because of the holiday last week. But they do have some data on NASDAQ 100. I think it's E-minis or minis, but it's a futures contract looking at that NASDAQ 100 part of the market. And you can get that weekly. If you look at that on a net notional dollar value basis, where we have been over the last, at different points in time, say over the last 6 months, is at levels that were a bit above the 2013, 2015 highs. And so if you go back over the whole life of the data series, we've seen that sentiment, so to speak, on the mega cap growth trade part of the market, very, very stretched, and more stretched than what we've seen over time. It has come down. It has not collapsed. We sort of look at it as like maybe the fevers come down from like 103 to 101. So it could obviously, kind of spike back up pretty quickly, and it's not back down to normal. But I think that's a good, sort of barometer for what I'm sensing in client meetings. Yes, some of the momentum has come off. Has it completely collapsed? No.
Just in terms of diversification, Lori, part of the reason that perhaps so many people went into this is you look at other asset classes. You look at bonds that are still negative. I mean, barely at this point, but still negative for the year. Base metals up only 3%. So you'd understand why people would go into this trade. But Lori, once that turn does happen and the conversations you're having with clients, are they prepared for it, or has diversification been thrown out the window for the sake of gains?
Well, I think it depends. It's a great question, Danny. I think it depends on which kind of investor you're talking about. Now, I spend most of my time talking to portfolio managers who run equity funds, and they're benchmarked to indexes like the S&P 500 or like the Russell 1000 growth. Some small cap managers in there as well, and value managers, obviously. But one of the problems that a lot of these managers have had is that even though they own a lot of these particular stocks, they can't be overweight because of structural reasons. So the kind of high-flying nature of these stocks makes it very, very difficult for them to outperform their benchmarks. If you look at actually sort of some quality factors in the market, and we talked about this in our weekly today as well, you're starting to see within the Russell 1000 as well as the 2000, most of the quality factors we look at are starting to work pretty well. That augurs well for active manager performance. So I think it's, not necessarily just a question of, do people like these stocks? Are they doing well? Are they going down? What does that do to absolute returns? Always ask about the long only PM. Are they outperforming their benchmarks? And I think if you actually take some of the heat out of some of those names, it can make their jobs a little bit easier.
Lori, we have the election in full swing this week with the kickoff of the first presidential debate. You told us early on this year that you continuously get asked about the 2024 presidential debate, but it's like looking into the sun. Have you gotten any clarity on potentially how to position ahead of this, or what you're now telling clients?
So I would say if you think you have to really divide it between the non-U.S. investors and the U.S. investors. If we look at the U.S.-based people, right, people who are sitting in the U.S. understand our elections, system the best and the issues at best. I continue to find that people just don't like talking about this issue. It's something that they've increasingly had to because they're getting more and more questions. If I think about some of my hedge fund conversations over the last month or two, I can definitely count a number of people who have told me that they're not making trades on this event, that they've done it in the past, but they're not doing it now. When I think more about long-only investors who are less inclined to sort of make those short-term trades, they're really struggling to understand the salient differences from a stock market or economic perspective between the two candidates. So you'll often sort of see people look at both agendas and say, well, these guys are both inflationary. So are we just looking at a higher inflation world over the next few years regardless? I think there's a lot of focus on the tax policy. That's where there do seem to be some salient differences that are really starting to come into focus. I had one investor put it to me recently and just sort of said, look, there's not a lot to do, but is this going to end up being something that sort of paralyzes the investment community for a period of time? And that is a thought that I think makes a lot of sense. I think there's a bit of fog here when you think about the 2025 outlook that the election is creating, even though there's not a sense that people really know exactly what to do right now with either outcome.
Lori Calvasina of RBC Capital Markets, thank you so much, as always, for being with us. Right now, let's get to an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Marine Le Pen's far-right national rally is making further gains ahead of the first round of France's snap election. According to Bloomberg polls tracking polls, the party has increased its lead to 34.2%. This means President Emmanuel Macron faces the increasing likelihood of having to share power with an opposition government. The first round of voting takes place on June 30th, and the second round will be on July 7th. Apple has been hit with the formal warning from European Union antitrust enforcers for allegedly stifling competition on its App Store. The European Commission says the iPhone maker must allow app developers to steer users to cheaper deals and offers outside of the App Store. The new order comes under the Bloc's Digital Markets Act, which lays out a raft of do's and don'ts for some of the world's largest technology platforms. And Boeing may be facing criminal charges. U.S. prosecutors are recommending the DOJ charge the plane maker for violating a settlement related to 2 fatal crashes. That's according to Reuters. The report, which cited people familiar with the matter, did not specify what charges the Justice Department is considering. The DOJ found in May that Boeing had breached the 2021 deferred prosecution agreement that was put in place after the 2 737 MAX crashes killed 346 people in 2018 and 2019. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Trump's running mate coming into focus.
There's a lot of interest, tremendous interest in the debate. And, you know, when you say prep, I think this is prepping.
Have you decided who your vice president is?
In my mind, yeah.
Do they know?
No, nobody knows.
That's coming up next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Heading into a week of, yes, that's right, politics, very much front and center as markets remain kind of range-bound, trying to find direction after kind of crawling to a weekly gain last week. We're still crawling upward, 55.38, just up about 0.1%. The euro just marginally stronger. Nothing going on in the bond space, and crude up about 0.5%. Under surveillance this morning, let's get straight to the politics. Trump's running mate coming into focus.
We have a lot of people coming. There's a lot of interest, tremendous interest in the debate. And, you know, when you say prep, I think this is prepping. These people know better than anybody what they want.
Have you decided who your vice president is?
In my mind, yeah.
Do they know?
No, nobody knows.
Here's latest. Former President Donald Trump saying his VP candidate will be in attendance in Thursday's presidential debate. Trump hitting the campaign trail in Pennsylvania while President Biden hunkers down to do debate prep at Camp David. Terry Haynes of Pangea Policy writing this. Only if Trump picks Nikki Haley for vice president does Trump have the best chance at victory. And the race materially changes if that happens. Our instinct is it's by no means impossible, but it isn't likely. Terry joins us now. Terry, before we even get to the vice presidential sweepstakes, there's a question of just this debate and what you're looking for in Thursday.
Well, fundamentally, what has to happen in the debate is I think that Biden has to exceed expectations. The expectations are very high for him the bar is a little higher for him to come in, and do what I call the frame, show that he's up to the job and show that he's the kind of kinder, gentler, centrist, safer pair of hands, as the English would say, compared to Trump. Trump, of course, has to not only disrupt but also embody the narrative of dissatisfaction with the economy, dissatisfaction with the border, and convincingly promise that he's able to make it better. So, to me, those are the basic basic touch gloves moments. But the stakes here, I think, are very high, not only politically, which is obvious, but I think also for markets. You all talked about, sadly, it's politics, but politics and U.S. political stability, is an underpinning of the market that's been taken for granted so long that most investors don't even think about it. That's starting to be tested now, not just in the United States, but the UK, France, and beyond.
Terry, what do you make of the fact that the president is hunkered down at Camp David? He's preparing with his team, it feels like, for days, taking it very seriously. Not saying the former president isn't taking it seriously, but he's out and about on the campaign trail, basically calling that prep. Is that going to work?
I think there's an awful lot of theater that's going on with Trump as ever. Saying he's prepping. Well, he's prepping, all right. He said also he wanted to take this very seriously. He's a little lighter on his feet than Biden is at this point. But of course, Biden's got more to defend. It's easier to be on the attack. So there's that, and of course, he's throwing red meat to the press all the time, whether it be this supposed vice presidential choice or anything else. So I tend to think there's a lot more going on behind the scenes here with Trump than he's letting on. Trump
also said that his VP choice will be in attendance at the debate, but no one knows who it is. Who are you zeroing in on?
Oh, well, I don't want to step on your lead, which was of my lead, which was, I think if he picks Haley, there's a material change in the race. That depends on the debate performance, of course. But that's a Republican unity ticket, and Trump very much needs that right now because the Republican Party remains split and independents aren't exactly flocking to him. That's the formula he needs in order to win. Beyond that, there are a variety of candidates. You kind of got unity light with somebody like Governor Youngkin of Virginia, and you've also got the attack dog idea, and that could be somebody like Senator Scott of South Carolina. It could be somebody like Senator Cotton of Arkansas. A lot of different choices. Where I'd put my money today is I very much doubt Trump's made his choice because he's not to the point yet where he knows with clarity exactly what he needs to do before the convention to unify the party and move forward.
You mentioned Governor Youngkin being unity light. Trump is going to Virginia the day after the debate. Is this a real potential? Does he think, one, he can really win Virginia, and two, Youngkin could be on this ticket?
Well, Virginia's a lot more in play than most people think. Back in 2016, I think it was, Virginia was one of a few states that came in under 5%. You've got a classic problem in Virginia, same as Illinois, New York, where you've got a blue core, in this case, Northern Virginia, and you've got the red, the rest of the state, and how those balance off determines who wins. Trump is very interested in pumping up red turnout in Virginia and also splitting blue turnout in Northern Virginia. He's got a shot at that. I think ultimately he's not successful at that, but the opportunity to put a state in play forces Biden to play defense, and so that's positive for Trump.
So just taking a step back, Terry, because this is a debate that is much earlier than it typically is in a presidential cycle. What does that mean for how consequential it will be?
Oh, I think it's very consequential because it sets a tone for the campaign. It's the first time that a great mass of the American public, much less a great international audience, has really focused on the American election in kind of a laser-like fashion. So it's important in that sense, and it is a tone setter. I don't think it's dispositive, though. The error that markets may see, that a lot of political people may see, is, oh, this happened, that happened, whatever happened in the debate, that's going to determine the state of the race going forward. It's really not. And I cited in my note to clients yesterday, examples going back to 2008, where the first debate wasn't particularly dispositive. And also, of course, this allows both parties, should there be an issue or a problem, to have the maximum amount of time for, clean up on aisle 7, political version.
Terry Haynes of Pangea Policy, thank you. Clean up on aisle 7 for the next 6 months. Is that what we're looking for?
Well, they're giving themselves a lot of time, the entire summer, basically, to clean up if Thursday does not go well for either candidate.
What are you watching, Danny, on these debates?
I'm so fascinated that they get their mics cut when they're not speaking. I want to hear if anyone tries to yell over it. Is that wrong? That's what I'm watching.
No, I hear that. Exactly how that's going to work in terms of cutting people as well prematurely. Coming up, KBW CEO Tom Michaud ahead of the bank stress test results this week, heading into the end of the first half.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
The start of the last week of the first half of 2024. Welcome back. Good morning. We're looking right now at a market that's trying to eke out maybe another record high, but really just crawling upward after last week, really losing steam. What we saw was the S&P outperforming the NASDAQ. This was a departure from what we had seen in the past, and we see that continue this morning. And we see the Russell 2000 continuing to outperform. To me, this is really the big takeaway, Danny, of what we saw over the past week. It's basically the Russell 2000 finally rearing its head with the biggest outperformance in many months as people look beyond just big tech.
But the question, of course, is can it last? Can it last if the data is just okay? Can it last if it's only one cut we're going to be having this year? With so much of the Russell 2000 exposed to higher debt loads, how aggressive of a rate cutting cycle do they need to have before it's actually attractive again?
And you went straight to rates, so let's go there. 2s, 10s, and 30s as people look forward to the idea of potential rate cuts. But is it for the right reason or the wrong reason? And that's the reason why small caps have been buffeted to such a degree. Last week, we saw a cooling in the economic data, ongoing disappointments. However, Friday's S&P global PMIs came out stronger than expected. So it sort of was this equilibrium that left people in a better place, at least for the small cap world. 2-year, 10-year, and 30-year yield basically going nowhere ahead of a slew of auctions. And I got to say, Emery, you were actually interested in the auctions this weekend, which I thought was fantastic. Welcome. But it really does seem like that's going to be very much in focus as a referendum on some of the political noise that we keep hearing about.
Well, the auctions are more interesting also because we have fresh CBO scores talking about the fact that the U.S. actually is spending more. And many are just pointing to the fact that this fiscal trajectory the U.S. is on is unsustainable. And then you start thinking about 2025. Wall Street Journal editorial today talking about what Senator Warner told us. Tax Armageddon. What's going on potentially next year. There's going to be a lot of debates about the trajectory of not just tax spending. We have the debt ceiling showdown in January, and all of this is going to put in focus how much the U.S. spends.
At the same time, the U.S. has been the least worst offender at some point, which is the reason why you've had seen dollar strength this morning. A bit of a reversal. We are seeing some yen strength versus the dollar for the first time in a long time after there were warnings from the United States not to intervene. And then overnight, Danny, we saw some discussion in the Bank of Japan meeting minutes saying they discussed potentially hiking rates further in order to strengthen the yen.
It's remarkable that the market either, one, doesn't believe them or it's yen vigilantes coming to challenge the MOF, because even though they might say that their last meeting, they didn't lay out their bond buying program, winding that down. So many folks said, okay, we're not going to get a hike next meeting because then you're going to have to lay out the program in that meeting. So what you get is yen weakness in this interesting little bout of strength right after intervention warning from the MOF.
Which raises a lot of questions, which we will get into in rumor form, not at all on the show. However, if we get solid reporting, we'll bring it to you. Under surveillance this morning, Israeli Prime Minister Benjamin Netanyahu telling local TV that the country will end the intense siege in Gaza soon, saying the next step will be redeploying forces to northern Israel, where its conflict with Hezbollah has spiked. Anne-Marie, how much are we underplaying the story of the conflict between Israel and the northern border with Hezbollah in Lebanon?
Well, Netanyahu telling this Israeli broadcaster that's going to be now the new focus. What I was struck by more, less what Netanyahu said, what we heard from the chairman of the Joint Chiefs yesterday. He was talking about the fact that if this were to happen, Iran would get more involved in support of Hezbollah. And the question now, everyone is wondering if this were to happen, and we would have more than just skirmishes, but really more of a conflict between Lebanese Hezbollah and Israel, will that trigger a broadening of this war?
That's exactly it, Anne-Marie. It's the threat of escalation. That's why markets were first worried when this happened, when it first broke out. Not even that. I mean, you look at last week, the leader of Hezbollah was threatening Cyprus, basically saying, you're allowing the Israelis to come use military bases to fly out of there to attack Hezbollah. I mean, now we're having threats against EU nations. It's, again, exactly the kind of escalation threat that markets are concerned about.
Talking about escalation, another forum on the economic front, Europe and China agreeing to talks over the EU's decision to impose tariffs on some electric vehicles. Earlier this month, the EU announced plans to impose tariffs as high as 48% on EVs imported from China, fueling trade tensions with the country. But Anne-Marie, it's not the 100% tariffs that you're seeing from the United States.
No, it's not. They still want to maintain that access to the European markets, which is why potentially they're saying, let's have legitimate discussions about this. Potentially they can lower some of those tariffs and maybe in lieu of that the European Union will still be able to import some of these luxury goods into China. We did have Vladis Dombrovskis have a call with his counterpart, and they said it was candid and constructive, both sides agreeing on to engage in the basic facts and in full respect of WTO rules. I think a lot of people in the United States would say that China has not been playing by those rules.
Well, and that is an ongoing potential tension between the U.S. and Europe, depending on how much their manufacturers depend on Chinese sales. Meanwhile, all eyes on the presidential debate and the Fed's preferred inflation gauge. That's due out later this week. We'll also get the results of the Fed's annual bank stress tests on Wednesday. They come, as the Fed said, J.P. Morgan, Bank of America, Goldman, and Citi all must approve their blueprints for a hypothetical wind down after the central bank found weaknesses in their plans. Joining us now, I'm so pleased to say, is Tom Ashad, CEO of KBW, a Stifel company. Tom, a lot of people have been raising this issue about whether we're fighting the wrong war and whether maybe some of what the regulators are targeting with banks is counterproductive for the current cycle. Do you think that that's going to be in focus later this week?
Well, I think, first of all, with the stress test, the first thing you're going to see is that the banks are in very, very good shape. Remember, the stress tests were set up to look at an adverse scenario to show the marketplace that they have plenty of capital to withstand that. And we think that the conversation is going to move away from that to individual company analysis quickly, which is actually a really positive statement about how the industry has been continuing to build capital. The other thing is the industry's not only been building capital for the stress test, but the industry's been building capital to get ready for Basel III Endgame. So that's been the big story. So I think the first box to check is that the industry is going to come out as being very well capitalized. And then there are going to be individual companies that are pivoting in one direction or another.
So there's a lot to unpack. There's a question about which banks, let's start here, are really strong and resilient, right? I mean, it's one thing to say JP Morgan and Bank of America and Citigroup aren't going to fail. I don't think anyone is saying that they're at risk of any kind of real potential turmoil. It's really the regionals. At what point do we get some confidence there?
So there are 23 banks in this test that's coming on Wednesday. So they start to go down into the super regional category. I think for all 23 banks, the market's going to say they have plenty of capital. I think for the regional banks are still in pretty good shape, except for the ones where there might be more concern around real estate exposure, for example, and you're seeing a downturn in some of their results. But by and large, and again, I think it's very narrow as to where the concern is. I just in preparation for coming today, I was interested about dividends. I went back and looked at there are 74 banks that are in the Keefe Bank Index or Regional Bank Index. If you look at since the beginning of last year, 5 of them cut or eliminated their dividend. Meanwhile, 54 of them raised their dividends over that period. The industry is actually in really, I think, pretty good shape for the challenges that we've had, and I think that the areas of concern are generally more narrow than you would think. And then remember, last year's bank failure moment was really around a liquidity crisis, and what we realized is that some banks had gotten offsides in terms of their concentrations in their deposits. I don't think that was a broad-based trend.
Even so, I mean, every now and again you hear of another bank that maybe isn't hedged to interest rates. The latest one was a large bank out of Japan, I think their largest agricultural bank, who was basically positioned for rates coming lower. Obviously, that hasn't happened yet. When you hear these incidents of pockets of stress, do you think that these are still the rare bank that haven't hedged against the current rate environment? Or if it's higher for longer, do we hear more of this?
So I think with the focus for this conversation right now being in the U.S., I'll go to our Bank America upgrade, which we did recently. We have earnings models by quarter for net interest income. I think just about all of the 220 banks we follow, nearly all, are going to hit a bottom on a quarterly basis, either last quarter or this quarter. That's the reason why we upgraded Bank America, is the second quarter is the inflection point, and it gets better from here. So it's all a question of timing. There's another point. The 3-month, 5-year yield curve spread is the most important for banks. I know that plenty of attention's on 2-10s. That's not the key for the banks. It's been 62 years since we've seen the length of time for the inversion that we've had. So all things really kind of need to do is get a little bit less bad for these banks to do a little bit better. And I think that pivot is right here, right now. And these banks have a lot of bad news in them. As long as we don't get a hard landing, I think you're going to see a continuing quarterly improvement over the next 4 or 5 quarters. And also, too, there are specific types of banks we like more than others. But this is a great opportunity if you can look longer term, we think.
I know you want to stay in the U.S., but I have to take you to Europe, especially
Okay.
given we're going to get one of the first rounds of French voting on the 30th. You've had the likes of J.P. Morgan really be courted by Macron, saying, come move to Paris in a post-Brexit world. And you've seen other U.S. banks do something similar, really building up operations and talent bases in Paris. If there is political volatility, what happens?
So I think it's really the big picture of what's happening with the economy. One thing I would note is over the last 12 months, banks have been the leading group in Europe. Again, there was so much bad news in these stocks, and really what you need in Europe is you needed some improvement in the rates. Negative interest rates were certainly adversely affecting the banks. Our sense is it all comes down to what the economy is doing. We still think there's upside for the banks because the banks have done a lot to stabilize themselves over the last several years, and many of those stocks still trade at 60% of book value. So we think that the bigger banks are stable in Europe, and it's a question now of what's happening in the economy.
Does it concern we heard last week from the Fed in terms of living wills of some of the U.S. biggest banks finding some shortcomings when it comes to the likes of Bank of America, Citi?
You know, you remember that teacher in college who was always a hard grader who never really gave out the, oh, this is perfect, you're all done, you don't have to do anymore? I will imagine for the rest of my career, every year there will be more work to do on a living will, okay? And if you look at the living wills, J.P. Morgan had work to do. Citigroup had work to do. Really, these living wills were evolving with the risks of the moment. And also, I would say, given last year's bank failures, the FDIC has probably sharpened their pencil on these living wills. But so I would view it as it's a living, breathing thing. I didn't see it. Our view on it is the banks are going to spend more money preparing for them, but that there was nothing devastating or really significant in what we read in the results.
I have to say, the reason why I started by asking you, are we looking at the wrong risks, is because in the past couple of years, first of all, the risks that I hear about, what profitability opportunities do some of these smaller banks have when they're facing off with the rush of money into private capital? That's a big question at this point.
Oh, there are some tectonic plates that are moving that if you want to take a step back and not look at the snapshot and look at the movie, yes. And really what it comes down to is funding and liquidity and deposits. Banks don't fail because of capital. Banks fail because there's a bank run. And there have been very few of them in the United States. So the capital's fine, but really what's happening in the deposit base, I think the greatest missed opportunity from last year is there's not been FDIC deposit insurance reform because it puts too much pressure on the small banks and it's encouraging market share to move up cap to the banks that have proven that they're too big to fail.
And it also, yeah.
So that's the biggest. And then number two is when it comes to stock selection, the way that regional banks, smaller community banks earn money in the biggest banks is very different. The smaller banks have more real estate and more spread income. They are going to be slower to rebound. The bigger banks Bank of America, amongst the biggest banks, has some of the least amount of commercial real estate exposure. These bigger banks have already made the shift away from that. And that's why we are leaning in heavier on these bigger banks for the stock ideas. We think it's going to take a little bit more time for the regional banks to turn.
There might be safety and even profitability in some of the bigger banks. There isn't so much of the classic market making, and this is the other risk that people talk about. Liquidity risk on another level, that they're not going to be able to shepherd this amount of bond auctions into the market and allow the trading to commence with the same kind of stability that it has in the past. Does that keep you up at night?
Now you're talking about the Treasury market?
Yeah, in the Treasury in particular, given the fact that the market has swollen to such a huge part, but it's also the credit market. I hear about this with public credit as well.
Well, what I take out of that is passive investing is at the highest degree of our lifetime and growing more, and in many ways it's changing the investment business. So there are so many of these indices and index-driven funds that so much of that, and it's impacted the liquidity of a lot of the smaller companies. So if you look at a typical mid-cap stock, it may have 35–40% of their shares owned by passive investors, and it's happening in the credit markets as well. So when you get to individual credits, so that's pushing more of the trading into private markets away from some of the public markets. And so I think that is going to have an impact. So the way in which companies raise capital is all still evolving because there's this big private market that's grown a lot in the last 4 or 5 years.
Tom Ashad, awesome to hear from you. Thank you so much for being with us.
Yes, thank you.
Tom Ashad of KBW. Meanwhile, we're looking at right now in markets is a bit of stability despite all of that. Up next, we're going to be talking about the Fed. September very much on the table.
We've had 2 great CPI numbers. It's not enough for the Fed to move, obviously, in July, nor do we think that they should, but we definitely think September's on the table.
That's next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Coming into a new trading week with a tiny bit of gains as we try to build on what we got last week. Again, just sort of limping to the finish with finishing up with 2 days of losses on the S&P, on the NASDAQ. Right now, gaining on the morning, up about 0.1%. The euro strengthening just a touch, yields just a touch higher, calm before a potential storm. Under surveillance this morning, September on the table.
We've had 2 great CPI numbers. There's things that are looking positive in terms of, as we talked about, jobs coming down, which should lead to lower wages going forward. It's not enough for the Fed to move, obviously, in July, nor do we think that they should, but we definitely think September's on the table.
Here is the latest. A key week of economic data on tap. We'll get consumer confidence tomorrow, then another round of jobless claims on Thursday, and the real big one is on Friday with the Fed's preferred inflation gauge, the core PCE deflator, in addition to personal income and spending. Robert Sawkin of Citigroup writing this. Our base case sees the Fed cutting rates in September. We expect a recession later this year, which leads to continuous easing from the Fed after this move. Robert joins us now. Robert, we saw last week a real shift in terms of the perception of the economic data, a question of whether the weakening was real, just weakness. You think it will turn into just weakness. How do you gain confidence at a time where other people see, for example, the S&P global PMIs and the U.S. PMIs on Friday, pointing to just a considerable amount of strength?
Yeah, absolutely. And I think this is a really challenging period for the data because depending on what you're looking for, you can find a story in a different set of data. So if I wanted to talk about resilience, as you said, I would note the PMIs, which surprised to the upside. And GDP for the second quarter still tracking pretty strongly if you look at the Atlanta Fed's nowcast, for example, something near 3%. But there's definitely softness brewing in a lot of other areas. In particular spots that we're concerned about is if you look at the housing sector, we've had very weak housing data. Multifamily housing starts are running at some of the lowest levels of the last decade. And jobless claims have consistently come in above expectations or stayed elevated for the last month or so. So we definitely think we're seeing cracks. Now, that being said, we've seen cracks in this cycle before that haven't materialized into a sharper downturn, and the broader economy has remained very resilient. So, a sharper downturn by no means is guaranteed, but I think the risks of that are higher than they were, let's say, a few months ago.
And one of the, I guess, cracks or maybe weakness, depending on how bad you think it is the consumer. But your forecast is that the spending starts to shift from services towards goods. What gives you the confidence of that, especially when so much of the language right now is just all-out price fatigue?
Yeah, absolutely. And it's been a really challenging forecast because we've been looking for this broader rotation into goods for a while, and you've just seen this very long tailwind of spending into services after the pandemic. It's been much broader and lasted a lot longer than we've expected. What makes us think that it's still likely to happen is, one, we think, again, a lot of that is built on this post-pandemic appetite for services that's likely to continue to fade. And two, we think those goods that were purchased earlier in the cycle during the pandemic, they're likely to wear out. And people are going to want to buy new goods like new cell phones, new computers, that incorporate new technology like the advances in AI. So we're still looking for that rotation. That should take some of the heat out of labor markets and inflation because good sectors are less labor intensive than services. And a lot of where we're seeing inflation now is still in services sectors. So I think that rotation, if it's done right, could be a very positive thing. But we have been expecting that for a while and still waiting for more of that rotation to come.
Do you need that rotation to maintain your call for September rate cut, or potentially these cracks you're seeing in the labor market might be enough?
I think you can still get to a September rate cut, even if you don't get the sharper downturn that our U.S. team has in its forecast. We're expecting just 0.15% for core PCE on Friday. Very important print this week. And I think if you continue to get market progress on inflation, even if the economy holds up well, the Fed probably by September is likely to conclude they've made enough progress to start easing rates. So even if the economy is resilient, I still think September is very much on the table. But that case that we talked about earlier of a continued easing after September, there I think you really need that sharper downturn. Otherwise, the Fed's going to start easing, but be very patient.
I want to ask you about the politics because you're global. You're looking, I'm sure, at both sides of the Atlantic. Yeah. It's a big week. Lori Calvasina talked about this paralysis, basically, in investments and in markets because of the U.S. election. Do you see politics impacting economic data right now? Can impact where consumers' sentiment may be going?
I think you see a lot of politics influencing market movements, especially as we've seen in France in recent weeks. And I do think on a sentiment level, you usually see politics influencing those numbers a lot because there's always a large politics element to things like consumer confidence measures, business confidence. However, I don't think anything we've seen to date is really enough to move the economic needle in terms of the data right now. I do think a lot of the results we've seen, like what's going to eventually happen in France, what we've seen in India, what we're going to see, of course, in the U.S. later this year, is going to influence economic policy a lot in the years to come. I think topics like migration are very much on the docket in all of these elections. In this cycle, for example, we've seen very large gains in migration, which is likely one of the reasons that the U.S. economy has been resilient. I think that's going to be a heated issue that's going to be debated in this election. So I very much look at politics as very important, but probably guiding the outlook over the next few years rather than shaping the economic data now.
I like that you talk about sentiment and this idea of what's affecting it. And a lot of people say, just ignore it and look at what they're doing. And what they're doing in the U.S. is spending and spending and spending some more because it's sort of the hedonism of the American consumer that you pointed out in a recent report has really lifted the U.S. to become one of the few outperformers relative to the pre-pandemic trend in the past couple of years. How important is spending on Friday? How important is it for it to continue in order to maybe suggest that this has another bout of strength before we really do weaken?
Absolutely. And in that report, as you know, we said the U.S. consumers sort of stood in a league of its own. If you look at major developed markets, Australia and the U.S. have been the two biggest performers in terms of growth. And that's really been a consumer story. And the U.S. consumer is a league above all of those other major developed economies. And that's why we've continued to see resilience. And as you noted, you've seen very soft consumer confidence measures throughout this cycle in many periods, but the consumers continue to spend. So I think it's very important. A lot of that spending's been on services. So when I see the sort of retail sales numbers, which have been a bit softer recently, I'm looking to the services side and saying, are they continuing to spend on services? But I think that is the backbone of this cycle. If the U.S. consumer starts to pull back, and we've seen some strains in lower income consumers, so you could get a larger pullback there, that would really be, I think, the signal the cycle would be turning. But right now, every quarter, the U.S. consumers just continue to spend.
Robert Sawkin of Citigroup, thank you so much for being with us. And there was this great statistics from Sri Kumar Global Strategies talking about how when you take commodities without food and energy, the prices actually fell by 1.7% during the 12 months ended May. Services, other than energy services, Danny, rose by 5.3%, more than twice the Fed's target.
I'm really fascinated by this idea that Robert was talking about, though, that if we are seeing some weakness, it's simply a consumer who's about to shift. That is about to shift from all the services that they started to hoover up once they came out of the pandemic and going towards goods. So it's, can this spending continue, but it just takes a different form.
Well, if you look at the data on Friday and the statement we got from S&P, led by service sector, that's reflecting this demand still. Everyone's still waiting for this potential rotation. And I feel like it's not going to happen this summer when you see an absolute resurgence of air travel and ticket prices to reflect that.
To Europe.
Yeah, well, this actually is something that we do need to keep talking about, is who is traveling, who is spending on services.
Bifurcated consumer.
How bifurcated it is, and how long that could continue before there's some real problems that develop. Coming up next, Seema Shah of Principal Asset Management, Isaac Voltansky of BTIG, BlackRock's Amanda Lynham, and Bloomberg's George Ferguson. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Markets are definitely moving somewhat towards this risk-off hedging bets against equity potential weakness.
Markets are a bit priced to perfection. It would be quite healthy if we can get some kind of consolidation over the next 3 months.
This is a time where we like to get consolidation. We have to sort of try and protect what we have.
Seasonally, it's lower volatility, but I don't think we've gotten to the point where people are capitulating.
You have to trade this market. You have to take a week to week.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Can Goldilocks continue into the second half of this year? Good morning. Welcome back. This is Bloomberg Surveillance from our New York City studios. Anne-Marie Hordern, Danny Berger, Lisa Abramowitz, John Farrow off. He will be back later this week. The reason why I really ask that question, can Goldilocks continue, is because there are signs underneath the market that there is a shift going on where suddenly big tech kind of hit a pause, Danny, and some of the small caps began to say, well, maybe we can begin to really come back upward.
I think if the shift happens in earnest, it would be painful, because if you look at what the market has been doing, diversification has not been a winning strategy, even though it is a bedrock of asset management. Bonds are not even up for the year yet. You have commodities still only up 3%. So you have a lot of households and funds that have shifted to really be overweight tech, because that's the only way you can beat the market. So if this shift is happening, how painful does it look?
Especially given what you said, the record overweights that we've seen in big tech. And it comes at a time where there's been a great deal of underweighting of small caps, even though people kind of did buy into this Goldilocks idea of disinflation without sort of falling off a cliff. How much did last week change that, Anne-Marie? And really this week going into the core PCE deflator, which is a key metric of inflation that the Fed looks at, but also personal income and spending at a time where there is clearly a softening under the way. It's just unclear how much.
Well, when it comes to deflator, potentially we're going to get really good news. This print is likely to be at the slowest pace this year. So we're talking about we're midway into the year. We actually might get some really good, important inflation data. I was struck by what Robert Slotkins had to say about jobless claims. They keep inching up. That's what we saw last week. Now this is at least a third week that we've seen this upside risk is now a serious crack in the labor market, and potentially is that a trend?
But, and the big but to all of this is it enough for the Fed? The Fed has been very clear that their bar is high for cutting, and that just another piece of data might not be enough because we hear the refrain, it takes months of data, and this is not yet months of this data.
And then there's a day of data, and that comes on Thursday, and then again on Sunday, and that is some of the political noise that is heating up. On Thursday, we get the first debate between Trump and Biden. A lot of people are looking to really that as the kickoff of a season that we believe has been underway for about a year now, but it seems like that will really be the true start. And then possibly even more impactful for at least the European markets, on Sunday, the French elections begin.
The French elections begin. The first of the legislative polling will happen on Sunday. And what you saw over the weekend, this FT poll, talking about the fact that Marine Le Pen's party is seen as doing better because of the economy. People are actually starting to trust potentially right-wing politicians when it comes to the economy. And I think that's going to be really interesting, because what you heard last week is investors talking about the fact that the move in the bond market we saw in France is not going away. It's basically the new normal.
And that's the reason why people are kind of watching to see what happens. 2 rounds of voting, at least in the French election. June 30th is the first, July 7th is the second. Right now in markets coming off just mild gains really across the board. You saw basically a NASDAQ that was flat on the week, and the Russell 2000 outperforming. S&P futures up, continuing to climb as the morning progresses, up nearly 0.2%, 55.42. You could see the euro gaining marginally versus the dollar after going north, going south of 107 on Friday, 107.32, reclaiming some of that today. And you can see 10-year yield just marginally softer, marginally higher, 426.51, with crude just up about 1/3%. Coming up this hour, Seema Shah of Principal Asset Management on a stretched market, Isaac Boltansky of BTIG ahead of this week's presidential debate, and Amanda Lynham of BlackRock with a busy week of Fed speak and economic data on deck. We begin with our top stories. U.S. stocks looking to a bounce back ahead of a busy week of politics and inflation data. Seema Shah of Principal Asset Management writing this: the potential for further equity gains may be somewhat limited from here with valuations so stretched. A soft economic landing is a necessary backdrop to support further gains. Seema joins us now. Seema, good morning. Welcome.
Good morning. Great to be here.
Great to have you. When you talk about stretched valuations, are you talking about the overall market, or are you talking about NVIDIA?
I'm talking about NVIDIA.
Okay.
Because if you look across the broad market, actually it doesn't look that stretched. We're really thinking about the pockets. It's difficult at this point, though, to look across and say, right, we need to have a broadening in the rally, but that broadening in the rally can only take place if there's still a sturdy economic backdrop. Now, we are generally quite positive on it, but we are hearing more and more clients actually really worried about the economic backdrop. Real concerns starting to creep in to the point that actually when we think about risks or we're hearing about risks, we're hearing more about what's going to happen with a hard landing than with an acceleration. And that is a very, very clear shift that we've noticed in the past few weeks.
And that's something that a lot of people are talking about. Morgan Stanley came out over the weekend, Mike Wilson, and he said he put there 3 scenarios that really counter this risk. One of them is overheating. Nobody thinks that's really going to happen. One is potential liquidity risk, and he talked about treasury auctions and some of the politics of the moment. And he said that the base case in terms of what could potentially disrupt this is, to your point, that hard landing scenario. How important is what we get on Friday in terms of personal income, personal spending, core PCE to really inform whether that's a more realistic base case?
So it's definitely important because obviously we know the consumer has been the key driver for the US economy. But you said the buzzword before, which is bifurcation, right? So you've got the really high income households, which are essentially carrying the US economy. You've got the lower income households, which are maybe seeing a couple of strains, but because the job market is still very strong, there's no major job losses, that they can almost continue going, and those higher income households can carry the US economy. It's really, to me, it's about the labor market, because if you start to see those jobless claims increasing, if you start to see it translating to job losses, well, then the lower income consumers can no longer, or I should say the high income consumers are no longer able to sustain the US economy.
And we talk a lot about what the landing will look like. We rarely talk about what the liftoff after that landing looks like. So if we're in this environment, we get this soft landing. How important is it that growth isn't anemic, that it can take off again for a more sustained and longer term rally?
So it is really important, but actually I'm going to say something slightly different. So when I think about the landing, we think that fine, you can get a soft landing up to Q1 and Q2 next year. But to the point that the Fed starts to cut, the people who are waiting on the sidelines to buy a property, and if you don't have job losses, I worry about how does the economy react to that? You could see another takeoff and then another acceleration. So actually, I think, to me, although I know that's not what people are necessarily talking about, although the acceleration is not key at the moment, maybe as you look to 2025, that is a theme that starts to return to the market.
No, I think that's such an excellent point, Seema, because it raises this question, is the Fed going to have the opposite intended fact when they start to cut? That everyone rushes to the market and all of a sudden housing prices go up, and how policy is usually transmission isn't transmission the way it is. So does that mean if the Fed starts cutting, they need to start cutting aggressively in order to make sure that it is not a housing market that takes off like crazy, that there's some incentive for supply to come back in?
I think they just have to be really careful how they cut. I mean, I do believe that they need to have all of the evidence in hand before they start those rate cuts. They need to be very clear that there is a softening in the economy. They need to see that the labor market is maybe not showing clear cracks, but there is a rebalancing taking place. Otherwise, they risk almost disrupting the economy again, and then we're being back to the same place as we were a few years ago in about 12 months' worth of time.
When it comes to the housing market, though, potentially those individuals that maybe they've wanted to upgrade to more space, but they're sitting on a 3% mortgage. What if all those people come into the market and then actually you have so much supply that it dilutes pricing power? Wouldn't that be almost a Goldilocks for the Fed?
It would be, but actually, I think although the supply has increased, the amount of people who are waiting on those sidelines, as you said, have been enjoying those 3% mortgage rates, but scared to go to buy a new property. Once they come back flooding into the market, I actually don't think that the supply is sufficient to stop the housing market from taking off again. So I think that that is one thing that the Fed really needs to keep a very close eye on in order to avoid this second wave of inflation, which, look, at the moment there is absolutely really no tool. I mean, there's something fundamentally driving it. I wouldn't compare it to the dot-com. But also when I look across at tech, I think they're somewhat macro-agnostic. I don't think they're necessarily reliant on what's happening in the macro space. I don't think they're necessarily reliant on the Fed space. I think they actually create their own demand. At some point, that party will stop. It doesn't look like it's anytime soon, but at some point it will stop. That, I think, is a very hard part to predict.
So you sound kind of bearish. What are you doing?
If I sound bearish, I don't mean to. I think that we should actually be slightly risk-on, but not as risk-on as we were about 6 months ago. So we do have a slight overweight to equities, but that has been pulled back a little bit because, as I said, we think that the equity gain is quite limited from here when you start to see that slight softening in the economic backdrop, and when there is so much concentration that sentiment is starting to get a little bit impacted, where people are getting a bit worried about how much exposure they have to these very, very high, these high stocks. Within fixed income, we actually think it should be back to neutral. Investment grade is probably the area that you want to be focused on with slightly high quality, but duration doesn't look very attractive to us. At 425, especially as you were talking before about the fiscal deficit, I don't see yields coming back down too far because that term premium is going to keep thinking about the deficit.
So are you just hoovering up French bonds? Because there's extra premium there, I hear.
French bonds really scare me, and the reason is this. So there is a genuine reason I think investors should be concerned about it. The discussions that are going on could really change the deficit narrative over there. Fiscal discipline out the window potentially. But also, if we're a US investor, you've been looking at Europe in the last couple of months saying, wow, is this real? Can this really be sustained? This political disaster at the moment, which is starting to unfold, is going to scare investors again. It's going to be like, oh, where are you again? European political basket case once more. And I think that is a concern.
I feel like that just leaves us back with the U.S. then,
It
Seema.
does.
Is that all this is? Is this just American exceptionalism 2.0 when you buy just, not America just because it's good, but because Europe is scary?
I think the US exception is very, very key here. There are pockets around the world, so it's not like it's just the US market. But certainly, as an overweight, where are we going to be focused on? It is certainly the US.
That's sort of the reason why, as much as people want to complain about, the auctions and, the deficit, you can't really do that because it's, Europe. Seema Shah, thank you so much for being with us. Seema Shah, Principal Asset Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Saudi Arabia said more than 1,300 people died during the annual Hajj pilgrimage as temperatures reached about 126 degrees Fahrenheit. That's the highest level in 2 decades. According to the Saudi press agency, the majority of fatalities were unregistered pilgrims who were not authorized to participate and walked long distances without adequate shelter. There were more than 1.8 million participants who traveled to Mecca this year for the pilgrimage. TikTok parent ByteDance and Broadcom may be teaming up. Bloomberg News has learned the two companies have held talks about a potential collaboration on an AI processor. In an earlier Reuters report, it said the proposed chip would comply with U.S. trade restrictions on China. The two companies' relationship currently revolves around server and networking gear, and Broadcom has cited ByteDance as a customer in its press releases. President Joe Biden taking on Donald Trump over the topic of abortion in a new video released this morning, as today marks 2 years since the Supreme Court overturned Roe v. Wade.
Decades of progress shattered just because the last guy got 4 years in the White House. We know what will happen if he gets another 4. For MAGA Republicans, Roe is just the beginning. They're going to try to ban the right to choose nationwide.
Trump has said he believes laws over abortion should be left to the states to decide. The topic is almost certain to come up at the first presidential debate on Thursday. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the potential for Trump 2.0.
Our strategic intent is to be as strong as possible in Asia, and we got there with Trump, and it'll go back again with President Trump when he returns in 6 months.
That's coming up next. This is Bloomberg.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
A little more than 2 hours to the start of the trading day, trying for maybe some more record gains after 32 of them so far this year. Is that right, Danny? 32?
Yep, 32.
Just sort of surprising considering the fact that we do seem to be kind of running out of that incredible momentum, up about 0.1% on the S&P. We are noticing, though, that the Russell 2000 outperforming once again after outperforming last week. Under surveillance this morning, the potential for Trump 2.0.
Our strategic intent is to be as strong as possible in Asia, and we got there with Trump, and it'll go back again with President Trump when he returns in 6 months. Because when the Japanese are engaged, when the South Koreans are engaged, when the Australians are engaged, and keep in mind all of these countries have raised their defense spending very significantly because of President Trump, and in Europe as well. You have to show tough love to your allies, and just like with family members, you have to be, sometimes you have to be a little tough with your family members.
Here's the latest. A new CBS poll giving former President Donald Trump a 1-point lead over President Biden ahead of the first presidential debate on Thursday. Isaac Boltansky of BTIG writing this. The election narrative will change dozens of times between now and November 5th, but we continue to view Trump as a slight favorite at this juncture. Isaac joins us now. Isaac, as you point out, this is just the beginning. We've actually been talking about this already so much, and I'm sure that there will be many more iterations of the narrative after Thursday's debate, regardless of the outcome. That said, why is Thursday still incredibly important at a time where it's a very close race?
Good morning. Yeah, look, I think it's easy to dismiss this upcoming debate. We've seen these two men on stage. We know what that looks like, and so I understand why we're discounting its impact. But look, this is going to be an incredibly close election. This last election between these two men was decided by 43,000 voters in just 3 states. And so anything that impacts the views of voters, even on the margin, matters. And I've looked at some data and some history on this. Generally, you will see upwards of 5% shift in sentiment around debates. Now, look, using the history when comparing these two men and this race is often dangerous. But anything at the margins matters here, given that this is going to be a historically close election.
Isaac, Terry Haynes came on last week and said that if President Biden does seem out of it or doesn't carry the energy that he has in the past that he did during the State of the Union, that there could be discussion of replacing him on the ballot. Do you think that is still a viable option?
Look, there's always going to be discussion of that. I think there's been discussion of that now for 2 years, and nothing has happened. And I think that's the reality here. You hear a fair amount of conjecture in town that this is the earliest presidential debate that we've ever had, in part because both parties want to see if they can replace their candidate. That is nothing more than hopium at this stage. I have seen no reason whatsoever to believe that we will see Biden replaced on the ticket. Biden himself and those closest to him believe he is the only candidate who can beat Donald Trump. And obviously Donald Trump believes that for himself as well. So look, if there is a massive gaffe or an incident or something that shakes up the race, sure, there will be more and more talk of this. But I've got to tell you, Lisa, I don't know who they're going to point to as the successor in waiting either. And so that's something that you've got to consider when you go down that rabbit hole.
Well, also, these two men are politically married and have been now for quite some time. Isaac, I was looking at some of the polling when it comes to Senate races versus the presidential race in some swing states. And you have some senators, candidates, doing better than the president. Does Biden get lifted by the down ticket, or does the down ticket suffer because of him?
Yeah, look, I think that ultimately that it's going to be a benefit in some of these states. I think what you've seen consistently with Biden during this primary in particular is a lack of enthusiasm. I think you've seen that in Michigan, you saw that in Brooklyn, you've seen that in other jurisdictions where folks were just voting no or leaving their ballots blank. And I think that ultimately how excited you see voters in states like Ohio and Pennsylvania could have an impact at the margin. To me, though, I don't think that it's going to be as meaningful in some of those Sun Belt states. They're the Sun Belt swing states where Trump is leading. That's Arizona, Nevada, and Georgia. I think for those other issues like immigration and inflation are going to be material drivers.
RFK is not going to be on the debate stage. Do you have a sense of how his votes will break in November?
No, and I don't think that anybody does. I think that that's the one of the conundrums when thinking about this election is no one knows how that's going to break. I mean, I have seen arguments from both sides that are thoughtful and detailed, but to me, this is really about enthusiasm and who shows up. And the thing that sticks in my mind is Trump supporters are loyal, they are fervent, and they show up. And so if we don't see that same level of enthusiasm from the Biden campaign, I think that that ultimately hurts the sitting president. And then you have the issue of RFK, which is, first, where will he be on the ballot? Right? So we know that he'll be on the ballot in Michigan. That's one of the swing states that matter. But we need to see if he's going to be on the other swing state ballots, because let's not forget, this isn't about national polling. There are 6 states worth 77 electoral votes that are going to decide this election. So it just matters if he's on those ballots.
Isaac, on the point of enthusiasm, we talk about a loyal base from Trump that has that enthusiasm, that shows up, and Biden needs to drum it up. Is there any clear strategy to do that? Are there things that have worked in this cycle or in past cycles that the Biden team should and potentially is tapping into?
I think that's where we are in this election, is trying to figure out what are those issues that can actually drive enthusiasm. And I've looked at the issues that really excite and animate those swing state voters, these 6 states that are going to decide it. And generally speaking, there are 4 that are highlighted. One is the economy, the other is inflation, the other is immigration, and the final one is abortion. And so what you're going to see is from the Democrats is to try to shift the focus towards that 4th bucket of reproductive rights, because that is something they think is going to animate suburban women in particular, which is a key group and a meaningful group for Democrats in their get out the vote efforts. And they want to keep it away from inflation, the economy, and immigration. And you've seen some of the strategy around that showing up already with the president's immigration moves over the past few weeks, where he's trying to look harder at the border. And I think during this debate, you're going to hear a lot of the focus from President Biden on trying to lower costs, trying to focus on junk fees, which is something that they've done, try to talk about housing affordabilities and issues like that to try to be forward-looking.
Isaac, I was joking with Anne-Marie and Lisa, but was kind of being serious that the thing I'm most interested into seeing is how the candidates handle a mic being turned off when it is not their turn to speak. I mean, I can joke as much as I want, but does the new format make a difference at all? You have that, you have no live studio audience, you don't have the prepared notes. How does it all play out?
I mean, look, first and foremost, I think it's deeply sad that we have to foster this element of civility here by turning off the mics and closing it to a studio audience. But if you look beyond that, I think that this is going to be a debate that's defined in a lot of ways by body language, right? You're not going to have the audible interruptions 100 times like you literally had the first time that these two candidates met on stage. But I think that there's going to be a lot of trying to dissect the body language from both candidates during this. And I think that'll be one of the themes the morning after, given that these mics are going to be shut off like we're in kindergarten.
I'm sure that we're all looking forward to analyzing the body language. Isaac, I am curious, though. We talk a lot about the mental capacity of President Biden and concerns around whether he appears strong, whether he appears with it. What about Trump? He's of a similar age.
Yeah, look, I think that there's fear on both sides that there's going to be a gaffe. I mean, look, there is good reason to believe that. And I think on Biden, you have 2 different Bidens. You have the Biden at the State of the Union, where that was a speech that he was prepared for. It was strong. It was resolute. He was commanding during that performance. His off-the-cuff press conferences have not been as strong, right? And so we now have that comparison there that I think that you will have a bifurcation in sentiment as you look at Biden's performance possibly on Thursday night. Whereas Trump has the benefit of being more off the cuff all the time. That is his 100% of the time personality. And so I do think the expectations are slightly lower for him because that is how he has always acted. Whereas Biden, you do have the duality of Biden with those 2 Bidens seen at different times.
Isaac Boltansky of BTIG, thank you so much for being with us. And Anne-Marie, that goes to exactly your point that you were making when Donald Trump, when asked, are you going to prepare? This is prep. That's kind of his tone.
It feels like they're setting the bar very low on both sides so that their candidates can clear them. But I think you bring up a great point about Trump's age as well. For both of these men, these are the oldest men for major political party candidates ever in U.S. history. There's a lot of firsts going into this debate.
Which I'm sure will leave this debate incredibly discussed by all of us. Mics getting turned off, body language, all things you can look forward to. Coming up, Amanda Lynham of BlackRock calling for a shallow rate-cutting cycle at a time where we just are on track for our first monthly rise in corporate bond spreads going back to October. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
2 hours away from the opening of the week of the day, we are looking at stocks that are marginally higher as we take a look at the potential for still maybe Goldilocks, possibly. We don't know yet, and whether leadership could potentially shift. We've been talking about this a lot. What you are seeing is a new trend, which is outperformance of the Russell. Can it last, as Danny's been asking, consistently throughout the morning, up about 0.25%. NASDAQ down, also a departure where you're suddenly seeing some nervousness around the tech dominance, while S&P futures do manage to eke out out a gain, but clawing back some of the gains from earlier this morning. In the rate space, not a lot of action this morning. The action will heat up, though, especially given the 2-year, 5-year, and 7-year auctions throughout the week. All of the yield space just marginally higher after a pretty significant rally last week, really led by, frankly, the 2-year. And Danny, this is sort of the question. Is the market moving away from the Fed and saying, you're going to cut rates, this data is giving you the confidence, stop it with the jawboning already?
I mean, I think it's just this frustration of listening to Fed speaker after Fed speaker say literally the exact same thing, that we need more months of data. The only variation you'll get is from a more hawkish member who will say you need more quarters of data in order to know that they're going to cut. So sure, the market presses ahead, but we learned the lesson earlier this year of what happens when you fight the Fed. Are we suffering from the same thing again?
I am curious. We were talking about the yen last hour. I am curious about, frankly, the euro. Given the fact that we saw a pretty great deal of euro weakness last week, we're seeing a bit of strength this week at a time when we're heading into French elections. We were just speaking with Seema Shah and Anne-Marie. She was basically saying it's going to revive this idea that it's a political mess in Europe and you just can't go there. This, to me, might be the most impactful market action of the week.
Seema Shah literally said French bonds scare me. Called Europe, what's going on in Europe. Sometimes there's political basket cases in Europe. And she says, and that's why you have to look to the United States. The U.S. exceptionalism, is it because the U.S. is so exceptional, aka NVIDIA, or is it actually because there's nowhere else to go? When it comes to France, though, we've seen obviously the repricing in the bond market, especially the record spreads with Germany. But what really unnerves investors is if there's skepticism in the European Union, the Eurozone. And at the moment, we don't know that yet. That remains to be seen. But if there's this cohabitation, potentially we won't get there.
And we keep saying that word just for you. You know, the idea that Marine Le Pen is actually saying she does believe in the Euro project and that won't become an issue, at least as of this moment. That seems to be a resilient concept. Under surveillance this morning, U.S. prosecutors are recommending the DOJ criminally charge Boeing, this according to a Reuters report. The charges would be for allegedly violating a settlement related to 2 fatal 737 MAX crashes in 2018 and 2019. Neither side has commented, and the report goes on to say no final decision has been reached. Danny, how much worse can this get for Boeing?
I mean, this also puts the regulators in between a rock and a hard place because Boeing has already had a lot of bad news. They want to see this fixed. They load something else onto Boeing, a criminal charge, that just creates another headache for them. Not to mention, I mean, they're a defense contractor. I'm not entirely sure how this works, but presumably it creates a headache if the U.S. Defense Department is buying stuff from a company that has a criminal allegation and maybe even a charge.
Absolutely. They're too important to fail for the United States, not just for making planes, but also for the defense industrial base. What is interesting is that the DOJ can basically force the company to admit its wrongdoing. So will they go after that guilty plea? And that might be very, very challenging, definitely from an optics point of view for Boeing.
I look forward to the day when we're not talking about Boeing anymore. Meanwhile, Apple may be turning to Meta as it looks to catch up on artificial intelligence. The Wall Street Journal reporting the tech giants have discussed incorporating Meta's generative AI model into Apple Intelligence. Apple already named ChatGPT as a partner for upcoming AI features later this year. Danny, it strikes me that Apple's throwing everything at the wall and seeing what sticks to see who they can partner with to sort of ramp up their AI as quickly as possible.
Such a good point. I mean, did Apple just go out to every AI-ish company and say, who wants to partner with me? I think it is interesting, though, because we're in this very kumbaya period of AI. Everybody wants a partnership. Everybody is working together. And kind of implicit in some of the price gains we've seen is that it's not a zero-sum game, that a hyper-competitive, all knives out, who can spend the most and do the best, that's not going to happen. I'm not sure it can last, but the partnerships maybe suggest we have this good feeling to last for a while longer.
At this point, there is this issue of kumbaya leading to antitrust concerns. I'm just saying, if you think about Meta and Apple partnering, I mean, talk about the incredible one. Maybe it's not NVIDIA. Maybe it's NVIDIA, Apple, OpenAI, and Meta mashup. I mean, at what point does this get people's attention?
Oh, I think it's already gotten people's attention, but it's really hard to regulate AI at this moment because no one really knows what we're going to be using exactly for. What I find interesting about the story is Apple will make money from it, from subscriptions if they go ahead with this, but Apple is notorious for being homegrown builders. So I find it so interesting that they feel this desperate need to really catch up, that they're going after, to Danny's point, literally everyone that has AI work in the pipeline.
All right. Well, meanwhile, consumer confidence and a host of Fed speak coming before the Fed's preferred inflation gauge, core PCE, due out on Friday. Amanda Lynham of BlackRock writing this: absent a sharp deterioration in the U.S. labor market, we expect only a shallow rate cutting cycle. Corporate borrowers will need to continue to navigate an elevated cost of capital environment. Amanda joins us now. And Amanda, this is a reason why I find what happened last week really interesting. And frankly, throughout the month of June, we have seen spread widening, unlike what we have seen since October. Is this beginning of a reckoning of sorts, albeit in a mild way, with this recognition of what higher for longer really means for the fundamentals?
Sure, and good morning. Thank you for having me. You're right. It's felt more choppy in the past week or two than it has in a while. We are still, just to level set, at spreads that are well below the historical average, but it does feel like for the first time in a while, the market has really been attuned to downside risks and growth. I think for the longer part of this year, it's been the resilient backdrop of growth that has allowed corporates to kind of absorb these higher debt financing costs. They've kind of moved along with it, as we've talked about before, refinanced even though rates are much higher. And I think now we're starting to think about what does that look like if we are in a prolonged higher cost of capital environment. The one kind of counterintuitive result, though, that we keep kind of focusing on is that actually we're seeing signs of either declining covenant defaults in the private credit market or declining distressed and default activity in the liquid market, which I think is really important for us to watch. At the same time, we're seeing recovery values increase. So does that mean that corporates are just kind of getting ahead of this? I think really the onus is on two things: the inflation data to come in line with the kind of good but not great expectation that Chair Powell has set, and then two, we need at least trend or above trend growth to make this okay for corporate credit.
It also raises the issue of pretend and extend, and how long can you actually do that before you run into some trouble? Oleg Malenkiev of Bank of America came out last week and pointed out that just 15% of low-quality issuers have reset their coupons so far. So even though people are talking about they're locking in longer kinds of rates and they're refinancing, that isn't the case for the most vulnerable companies. At what point does that become a true liability?
Yeah, so we're watching it in the liquid credit market, but also in the commercial real estate market. First, on the liquid credit market, we are seeing the high-yield bond market, for example, open to B- and CCC rated issuers. You're seeing a similar dynamic in amend and extend activity in the leveraged loan market. So while it may not be kind of a full force refinancing amongst the lowest rated firms, you are seeing the capital markets receptive to those borrowers. That was not the case in the second half of 2023, so that's really important to watch alongside the growth backdrop. The amend and extend activity in the commercial real estate market, I think, is probably more important, and this is using data from Real Capital Analytics. There was over $200 billion of debt that was supposed to mature in 2023 in the CRE loan market that did not. So presumably that was pushed into 2024, making that 2024 maturity wall closer to $800 billion, not $600 billion. So that is something that we're really watching, because that I would view as a short-term Band-Aid. I think we can all agree that when CRE loans are coming to be refinanced, they're doing so in a much more punitive environment, both based on the rates, but also lending standards and bank lending appetite and structural shifts. So that, I think, is probably the bigger focus. Now, for our part, we think that's a longer kind of slow-moving dynamic. I think the banks are trying to get ahead of that and saying that they're properly reserved. But I think when I'm thinking about amend and extend activity being a risk, I think it's probably more in the CRE market, because right now the syndicated debt markets are open to these borrowers. As you know, that can change quickly, but I think it's been comforting.
Well, okay, so a couple things to unpack there. Just on the real estate developers. So, okay, if we're still in this moment of extend and pretend, the maturity wall looks steeper. Let's say we just get one cut from the Fed in December. So you say it's slow moving, but what exactly does it look like?
So I don't think one cut or two cuts over the next several months is really game-changing for liquid credit, private credit, or CRE. I think the direction of travel and kind of giving some clarity to the market is very helpful. So in CRE, as you suggested, that could help the price discovery process, because there you could have buyers and sellers come into more alignment on what exactly that rate environment might look like. I would say we probably have more clarity on that now than maybe even 5 weeks ago when we were talking about the potential for rate hikes. And so I think on the margin, margin, it could improve some clarity in that price discovery. But I don't think it's game-changing for borrowing costs. And of course, in certain subsets of CRE like office, you have structural shifts in terms of office utilization. I will say CRE cannot be painted with a broad brush. There are parts of CRE that are doing very well: hotel, self-storage, industrial, even parts of multifamily. So this is very nuanced, very regional, but I do think it's more about buyer and seller expectations coming into alignment in the event of 1 or 2 rate cuts, as opposed to a wholesale rate relief. We're not expecting near-term significant interest rate relief.
Well, you also mentioned that the syndicate market is very much so open. Desks calling for something like $20 billion worth of issuance this week. So that continues in a large force. But as Lisa mentioned, spreads are starting to widen. So at what point, and are we close to it at all, where spreads widen enough that you get some of that issuance seriously backing off?
I think the bar for corporates to stand down if they have defined refinancing needs is very high, because I think they're looking at event risk in the second half of the year. And I think that it would behoove them to move forward, even if they're leaving something on the table, so to speak, in terms of spreads. We've seen periods of time where the high yield and IG markets have tried to sell off and actually buying has come in. I think really it's more about kind of the risk-off tone of the market and uncertainty as opposed to an incremental cost. If a corporate feels like they can't get a deal done, I think that is a reason to step down, but I think those instances are few and far between. I think embracing this higher cost of debt is something that we've seen, frankly, over the past year, 18 months from corporates, and I think they'll continue to do that.
When you say you can't look at CRE as all the same, they're not created equal, what gives you the most concern?
It's really that central business district office where, again, if you use that same Real Capital Analytics data, prices are down around 45% from 2019 using that index level data. And that's even worse than suburban office, for example. So it's really kind of older, obsolete central business district office that's not being utilized and that is really trying to have to fight for vacancy. I think we haven't yet seen the price discovery come through, because in real estate, you actually need transactions to trigger appraisals, and volumes are just still very, very muted. And so we haven't seen that flow through yet. We often think about kind of what inning are we in. I was operating under the assumption that we're maybe in the 6th or 7th inning. There are some folks who I really respect who think we're much earlier, the 4th inning. And so I think that is going to be a longer term trend. In the financial crisis, which I don't think we're anywhere near that sort of analogy, it took 34 months for a peak to trough decline. So I think we should be expecting this to be at least a few more quarters.
Since you are expecting turmoil ahead, I want to end on private credit and this sort of asset class that really has grown up post-financial crisis in the wake of some of the regulation that's pushed a lot of the asset class out of the big banks. And I'm wondering how much you see untested managers acting in ways, loosening up covenants, being perhaps a little bit more bold or risky in their behavior. Will there be some sort of washout or reckoning in the next 12 months as people realize this high rate environment is here to stay?
Right. So the idea of kind of throwing underwriting discipline to the side to capture market share is something that we're watching very closely. The stat that gives me comfort, however, is from Preqin, and it's that actually new entrants in private credit have raised around 2.5% of total capital since 2022. If you looked at that same stat from 2019 to 2021, that number was in the high single digits. So what is that showing? That's showing that the market's more discerning in where it's allocating capital. Private credit managers with 4 or more funds, by contrast, have raised 85% of capital since 2022. So I think that's saying that as we, and by the way, that same figure looked different in the ultra low rate environment of 2019 to 2021. So it's showing you that the market is becoming more discerning in where it's allocating capital. Could there be losses of those new entrants in private credit? Absolutely. May some of them be consolidated? Probably, yes. But it doesn't cause a systemic risk to the financial system. I don't believe so, simply for the fact that they actually haven't been that successful at gaining large amounts of capital.
Amanda Lydham, thank you so much for being with us. Wonderful as always. Amanda Lydham of BlackRock. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hakas. Yahaira.
Hi, Lisa. Israeli Prime Minister Benjamin Netanyahu says forces will soon end the intense stage of fighting in Gaza and will focus on targeted operations against Hamas. In his first major interview with an Israeli media outlet since the October 7th attacks, Netanyahu also directly rejected for the first time the prospect of a ceasefire deal with Hamas that could eventually lead to the end of the war. Target is partnering with e-commerce specialist Shopify to expand its marketplace for third-party merchants. Target said vendors using Shopify's platform can now apply to sell their products on Target's marketplace named Target Plus. This is the first partnership of its kind for Target Plus, as a retailer looks to catch up with larger competitors like Walmart and Amazon. And Bitcoin is extending its drop after crypto suffered one of its worst weeks this year. A gauge of the largest 100 digital assets fell about 5% in the 7 days through Sunday, the worst such decline since April, according to data compiled by Bloomberg. In earlier trading, Bitcoin fell as much as 4% to a more than 1 month low. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Boeing facing more headwinds.
Our culture is far from perfect, but we are taking action and we are making progress.
That's coming up next. This is Bloomberg.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Next up for this market is probably core PCE on Friday, as well as the Thursday presidential debates. Until then, we get a lot of second-tier data or third-tier data, whatever you want to say, including home price data, which will be analyzing significantly. Right now, you are seeing gains to start the week, at least in pre-trading activity, 55.40 on S&P futures, just nudging up about 0.1%. The euro clawing back some of the losses, some of the weakening of last week, gaining versus the dollar, 107.28. Yields marginally higher going into a slew of auctions, 2-year, 5-year, and 7-year tomorrow, Wednesday, and Thursday. 426 on that 10-year, and crude prices up about 0.5%, $81.09. And I have to say, Anne-Marie, a lot of people focused on just what's going on in domestic politics, but internationally, it does seem like there's sort of a heating up of Hezbollah in the north of Israel and what that could mean in a broader sense.
Well, Netanyahu said this. He said that that's going to become increasingly more of a focus for Israel. And then we had the chairman of the Joint Chiefs come out and say, if Hezbollah and Israel were going to expand in their skirmishes and it was going to get ramped up, Iran would come to the backing of Hezbollah, and then everyone starts to worry about, will this trigger a more widespread conflict in the region?
Which has always been a big fear, although it has been kind of shrugged off increasingly, maybe to a fault. Under surveillance this morning, Boeing facing more headwinds.
Much has been said about Boeing's culture. We've heard those concerns loud and clear. Our culture is far from perfect, but we are taking action and we are making progress. We understand the gravity, and we're committed to moving forward with transparency and accountability.
Here's the latest. Reuters reporting that U.S. prosecutors are recommending the plane maker face criminal prosecution. The charges would be related to two fatal 737 MAX crashes in 2018 and 2019. Bloomberg's George Ferguson joins us now. George, I love speaking with you, but I look forward to the time where we don't have to talk about Boeing again and again, because it really does seem to be this sort of anxiety-producing drone. I'm sure you feel the same way. How much is this sort of reprising the idea that there aren't the same kind of oversights at Boeing even to this day, despite warnings that date back as early as 2018?
Yeah, I think it is pretty surprising, right? Because I think coming out of the MAX grounding and those crashes, the crashes obviously beforehand, I would have expected they would have worked pretty hard to put all of those, all those controls in place that they were asked to do. So I think very surprising, and just another indicator of the challenges at the company right now.
George, does it give you a sense that this is basically a government that has its hands tied, simply because it can't really neuter a company that is of crucial national importance and really has a monopoly on the industry at a time when it is shown again and again that it doesn't seem to be able to put in place the necessary safeguards that even regulators have asked for?
Yeah, I mean, I think that I don't think the regulators' hands are tied dramatically. Like, I think they can get in there and do a bunch of work with Boeing to try to make sure they implement what they've asked them to do, the oversight they've asked them to do. I just think they want to be careful as far as, financial fines and anything that would impede their ability to compete. I mean, Boeing right now isn't on the best financial footing, right? They've got about $17 billion in cash. They've been burning cash pretty heavily. We're looking for them to, they've actually indicated, and we're watching to see if they can really ramp up production in the back half of this year to start generating cash, because they can't really, survive at the levels they are right now. So I think the regulators have to be careful from that perspective, but from the oversight perspective, I think they can go all in on this.
So does that mean potentially a monitor that can come in and look after the company, the financial penalties you discuss potentially likely, but the DOJ can also require the company to admit its wrongdoing by pleading guilty. What would that mean for Boeing?
So, I mean, I don't know how you make them admit they're wrong. I think they sort of have to come to that point. You got to prove it in court, but I think that's kind of a moot point at this stage anyways. I think that people understand that Boeing, had problems with MCAS. I think they've kind of admitted it, and so I don't know that would matter much to the company's financial performance or perspective in the marketplace. When people think of them, I kind of feel like that's sort of moot at this point.
Right, the damage seems to already be done. George,
I think so.
Can you give us an update on where they are with the CEO search?
I wish I could, but we don't know, right? We know that they've been in the middle of this search. We've watched some people take their name out of contention. It's a pretty rough job. I think we saw from Dave Calhoun's testimony in Washington, D.C. I think it was last week. The weeks blur together after a while. It's a really difficult job. There's a lot of questions to answer, a lot of work to be done on the factory floor. So I just keep coming back to they're going to need a real rock star from a manufacturing perspective. I think they're harder to find right now in America, but I think that's what they need, and we're not hearing much out of the company at all about where they are in that process.
Now, in that process, okay, because you talked about, some outsiders, Larry Culp from GE being one of them that was early floated as a name. Wall Street Journal reports he doesn't want the job. You need a manufacturing rock star. George, does that come from inside or outside of the company? Because an outsider would face the complexion that is the beast of Boeing, and an insider has been during Boeing during all of these problems. So where do they pick the CEO from?
I personally think it comes from outside the company, right? I think you do need a fresh look at the manufacturing processes. I don't think you need, it appears that there's been a breakdown inside Boeing in sort of that core manufacturing, core oversight of employees training. So I think you need someone to come in who's done it very well somewhere else. And it seems like there is a problem with Boeing culture. And so I don't know that you'd want to pull out of that culture.
Bloomberg's George Ferguson, thank you so much for being with us. And hopefully the next time that we talk to you will be about airline trends and other things other than Boeing's malfeasances that seem to be coming up time and time again. I say this because honestly, we talk about the travel season, right? And we talk about how all the U.S. Consumer, particularly the well-heeled one, is heading over to Europe. This is what we should be talking about, right? Is sort of the demands for the crowds. This in the Wall Street Journal. Americans are all over Europe this summer. Here's how to outsmart the crowds. I mean, at what point are people just not watching anymore?
Oh, what were their ideas for outsmarting the crowds? I need to look at those tips before I head back to Europe at some point. We are seeing this resurgence, though, in travel. It feels huge this summer, and yet the concerns are, of course, about how safe is it to travel right now when you get headline after headline about Boeing, but are people just holding their nose and getting on the flight?
I mean, do you really feel worried about it? I feel like when I was a child, I was worried about flying, and then I just sort of shrugged it off and said, I'm probably riskier going out in the sun, and I might get, melanoma. I mean, at a certain point, it's sort of how much are we just sort of being...
Riskier to drive.
Yeah,
it is
exactly.
much riskier to drive. And, for people who have really intense flight anxiety, they tend to get something prescribed, and they can deal with it, too.
Well, there you go. Advice. If you're going to Europe or trying to travel, from Danny, get medication. Coming up, Vino Krishna of Barclays, Tom Narayan of RBC, Vishy Terapatur of Morgan Stanley, and Stephanie Roth of Wolfe Research. Really interesting from Vishy Terapatur, talking about credit markets and the role that they play within artificial intelligence, in addition to some of the trends that we were talking about with Amanda Lynham. Right now in markets, you can see a sense of a bit of a pullback from last week. The idea